A very good afternoon to all the participants. On behalf of Financial Reporting Review Board, I, C. Ankita Mangla, Secretary FRRB, extend a warm welcome to this insightful webinar on commonly found non-compliances observed in the financial statement and auditor's report. This is the sequel of our earlier webinar held on 23rd April. I also extend a warm welcome to Chairman FRRB, C. Vishal Doshi ji, Vice Chairman FRRB, C. Hansraj Chugji, whose constant guidance and leadership have been instrumental in shaping the board's endeavors. We are also delighted to have with us the eminent speakers, C. Chinnasamy Ganesan ji and C. Vivek Agarwal ji. We welcome you, both of you, sir, in today's webinar. We are truly honored to have you all in this webinar. Now I request Chairman FRRB, Vishal sir, to deliver the welcome address. Thank you.
Thank you very much, and a very good afternoon to all the participants who have joined this webinar, the sequel of the first webinar that we had. A very good afternoon, and I welcome our respected panelists, Vivek Agarwal ji and Chinnasamy Ganesan ji. I also recognize the presence and welcome our Vice Chairman of the Financial Report Review Board, CA Hansraj Chugji. And friends, it's indeed I would say a very happy moment today that we have all gathered to continue with the discussions that we had left about a fortnight back on the commonly found errors with respect to the financial statements and more so with respect to the Ind AS. And let me tell you, in the meanwhile, in this gap of 2 weeks, we've got a lot of positive responses about the initiatives and the activities at the FRRB that we are doing. And just for the benefit of members, that the Financial Report Review Board is a regulatory committee of the Institute of Chartered Accountants of India. Because if you read the CA Act, the ICI is to regulate and develop the profession of the chartered accountancy. And this is a regulatory role which we do in the FRRB, where we review the financial statements of different enterprises, where we check the compliance with respect to the generally accepted accounting principles. We check compliance with respect to the disclosure requirements, with respect to the relevant rules, regulations, and also with the compliance with respect to the regulatory or the reporting obligations that each entity has. It's more of a desktop review we do, so we don't interact with the auditor or the auditee, the company, the enterprise. We do whatever review basis the financial statements that are before us. We also support the regulators, that is the MCA, the Ministry of Corporate Affairs, SEBI, the IRDAI, the RBI, the CNAG, ECI, that is the Election Commission of India, NABARD, NITI Aayog, CBDT. So all these regulators we support, because they also refer many financial statements to us where they find that there are possibilities of any accounting irregularities that might have happened, and they refer those financial statements to us. So broadly, this is what we do on the regulatory front. And at the FRRB, we have a process, a protocol of how we select the different enterprises for review. So we take from the in the index-based companies, we also take companies on the different economical aspects or the sectors of the economy that they may belong to. So, you have the FMCG, you have the pharma, you have the ITES space. So we ensure that broadly all the sectors of the economy are represented in the sample that we pick up. And we have also now included new, I would say, criteria for selecting companies like highly levered companies where the debt equity ratio is very high, where there are negative reserves that are there in any company, where the audit fees is pretty low in comparison to the turnover or the level of activities of a company, and also companies which go under IRP and in the immediately preceding financial year, the auditors have issued an unmodified opinion. So these are the new parameters which we have included for selecting various companies. And during the process of our review, we have a 3-tier review system where we have the technical reviewers, then we have the financial report review groups, and finally we have the board, the financial report review board, which goes through all the observations and looks into it and also decides based on the basis of the observations that if any of the observations are there which are material and which may impact the true and fair view of the financial statements, then those cases are referred to the director discipline, as well as are also referred to the regulators for their knowledge to initiate action against the company and the management. And if the observations are there, which are, I would say, technical inconsistencies that are there, but they are not material that may impact the true and fair view of financial statements, and in such cases, a letter of advisory is issued to the auditor. So broadly, this is how the FRRB functions, and I thought this could be a good platform to share the process with all our members, all our participants. And as a part of this process, like I said, that we do a lot of these reviews, a lot of observations are there, and we come out with publications which are available on our FRRB webpage, where we have come out with three publications, three volumes, only commonly found errors with respect to the Ind AS that are there. Most recently being on in Feb 25, where we released the third volume, which has more than 200 cases of non-compliances covering 88 financial statements. And we also have three volumes of the accounting standard IGAP related non-compliances which are there. So there are six publications in total. And that is where we thought that we have been doing a lot of physical programs, awareness programs on the non-compliances with respect to the financial statements. So the Ind AS, the accounting standards, the Schedule 3, the CARO requirements, the auditing standards, other provisions of Companies Act. And till date, we have almost done, I would say, in the last 1 month, we would have done about 17 programs in physical form across the country at different branches. And this is our second webinar. The first one we did about a fortnight back. And since we were not able to complete all the questions because of the wonderful interactions that our panelists provided, we have been forced, I would say, to come up with a sequel. So thanks to the panelists who were there in the last and who have agreed to be here today also, so that we can continue our I would say the session on the question and answers. And let me tell you, friends, in the last webinar also, there were questions that had been received, and we had assured the participants that they would also be addressed today. So I would, with this, I once again welcome all of you and request Ankita ji to kindly take the session forward. आप म्यूट पे है.
Thank you, sir. Moving on to the session. Before I hand over the proceeding to our panelists, I would like to introduce our eminent speakers to the participant. C. Chinnasamy Ganesan ji is an expert in the field of auditing, bringing over 36 years of rich and diverse experience. He has delivered more than 1,500 lectures globally on auditing, Ind AS, and financial reporting. He has authored several books and has been instrumental in guiding over 80 companies in their Ind AS transition. His accolades includes an honorary doctorate in IFRS, the Lifetime Achievement Award in Finance from Rotary International, and the prestigious Jewel of India Award for his contribution to the financial services. He is faculty at prestigious institutions including IIMs, RBI, C&AG, CII, FICCI, and leading universities across India. C. Vivek Agarwal ji is a distinguished fellow chartered accountant and fellow company secretary with expertise in India's forensic audit and assurance services. He holds a diploma in IFRS from ACCA UK, visa from ICI, and certification in forensic audit and Ind AS. Additionally, he has pursued an executive course in business analytics from IIM Calcutta. He is a seasoned speaker, having addressed over 1,000 national seminars and workshops on Ind AS, IFC, auditing standard, and has also served as a trainer for government bodies, including the Minister of Finance and C&AG. We are truly honored to have both of you as speaker for our today's webinar. Now I request Vishal sir to kindly commence the today's webinar.
Thank you. My first question is to Vivek ji. Vivek ji, it was observed that a company had designated investment in quoted equity shares as at fair value through OCI, other comprehensive income. However, as we all know, this is an alternative presentation, but the reason for using this alternative presentation was not disclosed. So with this background, the questions are that why does an entity actually choose the alternative presentation for its investment in equity instruments? The second question is that once adopted, is an entity permitted to change the presentation for its investments in the equity instruments? And why is such disclosure for any alternative presentation required?
Thank you, Vishalji, and thanks to FRB for giving me this opportunity. A very important question in regard to fair valuation of equity instrument. Under Index 109, an entity may, at initial recognition, make a irrevocable election. Mind you, it is an irrevocable election to present subsequent changes in fair valuation of investment in equity in other comprehensive income instead of profit and loss account, which is also known as alternative presentation. However, India's 107 financial instrument disclosure paragraph 11A requires the entity to disclose the reason for using this option. And when we ask why these options are used, because there are many companies who invest the surplus in equity instrument, and it is not their day-to-day activity to keep on investing in equity and buying and selling equity shares. Many companies do investment in the competitors' companies to maybe acquire in long term or also to keep a track of their records and financial statements, etc. Entities may opt for fair value through OCI classification at initial recognition for various reasons. Why? Because if they continue to do fair value through PL, the profit and loss account may become very volatile. So to reduce the profit and loss volatility, unrealized fair value changes, which is required to be there as per the accounting, and companies don't want that to hit their PL. So thereby stabilizing their PL by recognizing the equity instrument from fair value to OCI. Secondly, it may be a long-term investment which are held for like maybe a minimal percentage of 2, 3, 5%. They acquire that for long-term purpose and not for trading gains. And it may be strategic investment, and they don't want their profit and loss account to fluctuate due to those investment. And many a time, to make sure such profit and loss is not shown in PL because it is not in their genuine nature to do that business, or it is not the objective to purchase or sell the equity instrument, and to avoid the recycling of those income to profit and loss. Because when we do equity instrument which are carried at fair value to OCI, the recycling is not there to PL. And on disposal of this profit and loss, it is never reclassified or never taken to profit and loss account. And obviously, they want to align the accounting with the business intent, the object, where I said as the objective may not be to earn income from those investment, it may be strategic investment, it may be for various other reasons, maybe a long-term target to acquire those companies. Therefore, for all these reasons, the company wants to go for carrying the equity instrument at fair value through OCI. And as I was saying, once adopted, is an entity permitted to change the presentation? No, change is not permitted. Because as per India's 109, once the entity makes the irrevocable election and initial recognition to present the fair value changes in OCI, it cannot be subsequently reclassified to PL. And to maintain the consistency, this irrevocability is there. And why is such disclosure required? Because ideally, investment should be carried at fair value to PL for equity. But these options are given as the entity may say that it is not aligned to the objective. And if a company is taking this profit or this fair value changes of equity to OCI, it's better information to increase the transparency, to have an informed decision making, to prevent misinterpretation. What happens? Many investors, many bankers, they don't like a company investing in equity shares. And if those companies are investing in equity shares and taking the profit and loss to PL, it deviates that objective. And if companies are investing for long-term purpose and carrying it to OCI, it gives a comfort to the investors, to the bankers, to various stakeholders, where the company can say See, I'm not taking this profit to PL. I'm neither recycling back to the PL when I'm disposing it off. So it is not aligned, or it is not for my business objective, for other reason for which I have taken this investment. So disclosure is required for Ind AS 107, where it is said to bring the transparency, informed decision making, prevent misinterpretation, and obviously compliance with the standard. So with all this reasoning, we can say that the company can go for fair value to OCI, but if a company goes for fair value to OCI recognition for equity shares, they have to give a detailed justification or reason why they are going for fair value to OCI option, which is also known as the alternative presentation. Over to the board.
Yeah, thank you very much, Vivek Bhai, for wonderful deliberation and the way you have explained with. Now, my question will be to Ganesan ji. Ganesan ji, it was noted from the statement of profit and loss account that expenses includes a subhead administrative expenses. It indicates that the company has classified the expenses based on the functional classification. Is it appropriate for the company to classify expenses under the administrative expenses? Does it represent being based on the nature or on function under the Ind AS? Ganesan ji, over to you.
Thank you, sir. Thank you both chairman, vice chairman, and the board for giving the opportunity of interacting with the members again. This particular question is coming from Ind AS 1, presentation of financial statement. There is a major difference between Ind AS 1 and IA. To classify the expenditure in the profit and loss account based on nature of expenses model or on functional classification model. But when we have adopted or converged the accounting standards in India, we have taken a very conscious call that only the nature of expenses model will be used for the presentation of financial statement, and the functional classification will not be used. And accordingly, in this particular case, where they have used administrative expenses as a functional classification, they are not in compliance with the Ind AS 1. And accordingly, there is a common error which people are misunderstanding the application of Ind AS 1, and they are simply get carried away with the requirement of IAS 1. So this, I wanted to reiterate that Ind AS 1 very clearly specifies only nature of expenses model is permitted in the statement of profit and loss account, and no way you can use functional classification. So accordingly, in case if you are having some confusion on this, please be very clear that functional classification is not available even as an option under Ind AS 1. Okay, thank you.
Yeah, I think so. Yes, but going forward, the Ind AS 118 would change a lot of this feature. So, but yes, that is at a later point in time. When we'll come to it, we'll have a detailed deliberation on that. Just continuing further with Ganeshanji, asking one of the questions that the participants had asked last time. With respect to, there was a question on the insurance claim with respect to the disclosure when it is a loss of inventory vis-a-vis the loss of property, plant, equipment. So our member has asked that what should be the accounting treatment if the insurance company has disputed the claim and the matter is under litigation. Can the company recognize such a claim in the balance sheet, in the financial statements as on the cutoff date?
Again, to answer this question, I am taking two technical literature. One, as per Ind AS 37, provisions, contingent liabilities, and contingent asset. And another is there is an expert advisory committee opinion issued by the institute on how to account for the insurance claims as well. So in both the scenarios, what is expected is if you wanted to recognize an asset based on the framework for preparation of financial statement under Ind AS, the asset means you should have a control over an economic resource out of which the benefit should be flowing to the entity, and the cost should be reliably measured. These are all the conditions which has been given for recognition of an asset. If you put this particular case into our practice, what we are seeing is that the insurance claim, even though it is an asset, in case if it is approved, or we are going to receive that as a economic benefit to the entity to set off against the actual losses which we have incurred. But still, in the present case, it is very clearly mentioned there is a dispute, or it is under litigation. That means the amount is not very clearly defined, and the entity is not having the complete control over the economic resource. And accordingly, we are able to assess this only based on what is going to be the future event, or maybe what is the outcome of the particular litigation. And to that extent, if the entity has want to recognize that as an asset, it is not correct, because Ind AS 37 very clearly states this type of situation is only a contingent asset. Fortunately, in contingent asset, we have one difference in Ind AS 37 and AS 29. In AS 29, if it is a contingent asset, no disclosure is required, no accounting is required. But when it comes to Ind AS 37, if the contingent asset is considered to be material, a disclosure is required. You cannot recognize that as an asset, but a disclosure is required. In this particular scenario, I believe that they have to only make a disclosure, because the insurance claims in such cases will be material in accordance with Ind AS 37 as a contingent asset, explaining the description of the claim and what is the dispute which is pending, and what is the probability assessment made by the management that it will be recoverable or not. So that is as far as Ind AS 37 disclosure is concerned. If they have already recognized that as an asset when it is under litigation, this is incorrect presentation of financial statements.
Right. So now I will move on to Vivek ji, and this is in respect of Ind AS 12 income taxes. So the FRRB observed in one case that the company has disclosed the profit for the year and tax expenses in the statement of profit and loss. However, no other disclosures were given in this regard. So the question is that, are there any requirements under Ind AS for reconciling the difference between the reported tax expense and the tax computed on accounting profit? And what are the key factors that can contribute to this particular difference?
This is a relevant question, and this question is very relevant in today's also ecosystem when India is still maturing, because this is where most of the finance controller and the small size or mid-size firm struggle to give this reconciliation. So, what is the requirement of the standard? Index 12 is very clear in that, but there is a specific requirement to disclose the reconciliation between the reported tax expense and the tax that would arise by applying the applicable tax rate to the accounting profit. And this mandate is there in the Index 12. And it requires, there are two options. Number one, there can be a numerical reconciliation between the tax expense and accounting profit multiplied by the applicable tax rate, with disclosure on the basis of which the applicable tax rate are computed, or numerical reconciliation between the average effective tax rate (ETR) and applicable tax rate, again disclosing the basis of the applicable tax rate. What exactly it is? Uh, Say you have a profit as per your books of accounts is say 100 CR, and you are paying tax of say at the rate of 25% basic tax rate without any other cess and surcharge. You are paying a tax of say 30 crores. So if the profit is 100 crores, then your tax should be 25 crores, but we are paying 30 crores. So what is the reason for this difference? That explanation is required under Ind AS 12 paragraph 81. And Vivek, why there are differences, or why this difference arise on the first hand? Because of the what we make as a computation from the accounting profit, we derive the taxable profit, and there are various reasons for this taxable profit and accounting profit difference. Example, you can have a brought forward losses due to which there can be a difference, or there are some there are temporary difference like 43B income tax, where something is allowed on cash basis. There can be tax incentive or holidays for certain income earned. There can be different tax rate. Suppose there can be long-term gain where the tax rate is different. There can be short-term gain, and there's a business profit. In accounting profit, it comes together. But in tax, they have different rates of tax which applies. So on the basis of this difference, there can be difference in the uh, tax rate per se or tax expense as per books and tax expense as per income tax. And for all this reason, this disclosure is very much required to be given. And there is numerous times there are gaps found in this where the reconciliation is not there. So many companies, what they do, they prepare both the reconciliation and cross-check with both. Some of the large corporates give both the disclosures, either of it. The requirement of the standard is that either of the disclosures should be there. Thank you. Over to Vishalji.
Yeah. Now I'll be moving to the another question to Ganesan ji. Ganesan ji, it was found in one of the financial statement, MAT credit entitlement was classified as other non-current assets. Is the classification is correctly been has to be there, or if you have anything to suggest, if not, how it has to be classified?
So there are two issues coming here. One is whether MAT credit entitlement is a asset or it should be classified as part of deferred tax. So Ind AS 12, which we have to look at. And we should also look at whether the MAT credit entitlement will continue to be an asset. I think in this particular example, we are assuming that the company is under old tax regime. If the company has moved to the new tax regime, there will not be any possibility of carrying over the MAT credit entitlement. That's the reason why when the particular tax regime has been brought in, there was a transitional adjustment which has been carried out in respect of opening balance of MAT credit entitlement. When we are looking at of division 2 of India's schedule 3, that is India's format of financial statement to be adopted by companies who are under India's regime. There they have made very clearly what was referred in Ind AS 12 as against what is given in AS 22. In AS 22, we are actually talking about timing differences as a profit and loss account model, whereas under Ind AS 12, we are talking about temporary differences based on a balance sheet approach. The moment we are talking about balance sheet approach, the items which uh, are tax credits which are allowed to be carried over or recoverable in a future period should also be considered as part of deferred tax asset. In our example, for example, under section 115 JB, if you are taking the MAT credit entitlement and show that as an unused balance as an asset, naturally, this will clearly fall within the definition of unused tax credit, which can be carried forward and adjusted in the tax payable for the future period. And to that extent, it is getting covered by Ind AS 12. Accordingly, the company is who is having MAT credit entitlement and it is continuing to be under the old tax regime should take the MAT credit entitlement as part of the deferred tax asset net in the balance sheet. So in the note referred to for the deferred tax asset net, we will have the deferred tax asset arising out of timing difference, temporary differences relating to item number 1, item number 2, etc., less deferred tax liability arising on temporary differences due to item number 1, 2, 3, 4, whatever. What is the net deferred tax asset? We will show that number. Then we will show what is the MAT credit entitlement receivable as the next item. The total of that will be the deferred tax credit net according to Ind AS 12. That should be linked to the amount shown on the face of the balance sheet for deferred tax asset net as per division 2 of schedule 3 to the Companies Act. So accordingly, in this case, where the company has shown this MAT credit entitlement as part of other non-current asset, it is totally incorrect because of the application required to be in accordance with Ind AS 12. It should be part of deferred tax asset net and not part of other non-current asset. As I have already told you, in case if the company is under new tax regime, they have adopted new tax regime, they cannot carry over any MAT credit entitlement receivable. And in case if they are carrying it over, that is totally incorrect. It should have been charged off. Okay. So that is the two levels. I assume in this question, it is under the old tax regime. So it should be part of deferred tax and not to be part of other current assets or other non-current assets. Thank you, sir.
Yeah, thank you, Ganeshanji. My next question is for Vivekji, which is on the disclosure of accounting policies. From different financial statements, there were different observations. So one being that as per the note on the revenue, the company has earned significant amount of revenue from EPC work, that is the engineering, procurement and construction work. However, no accounting policy on recognition of such revenue was given. In another case, the accounting policy on dividend income as well as employee benefits has not been disclosed, though when we look at the statement of profit and loss, these means dividend income and the employee benefit expense show a significant amount. In another case, the third case, the accounting policies regarding the initial and subsequent measurement of financial assets have not been provided. So the question is that when we do a review in all such cases, that should a company disclose its accounting policies if the related transactions or balances are material, or can such disclosure still be considered material due to the nature of the transaction, events or conditions, even if the amounts involved are not material or immaterial? Over to you, Vivekji.
Thank you, Vishalji. Very important question. And with material accounting policy, which came in 2023-24, and there was great hue and cry with the amendment in this one about the material accounting policy. Earlier, we used to have significant accounting policy. Now, material accounting policy information. It is an important aspect because the accounting policy should be there to help any stakeholder to give more clarity of the financial statement. And when we talk about material accounting policy, India's one is very clear. It states that the disclosure of material accounting policy information is required. And if this means that the company should provide accounting policy details if they can reasonably be expected to influence the decision of the primary user of the financial statement. So we may say, Vivek, what are those material accounting policy? Anything is material if the transaction itself is immaterial, then its accounting policy need not be disclosed. But the transaction itself is material, or materiality is not only about the amount, it also includes the nature of the transaction. So, if the amount involved are small, but the nature of the item, for example, a significant type of income or a major category of asset or liability, can make the accounting policy material. So when we come to our question separately, like yes, a company must disclose its accounting policy if the related transaction, balance, or conditions are material, or the nature of the transaction, event, or condition is such that it is material even if the actual amount is immaterial. Say a company has a good amount of investment in shares, but the dividend income is very small or very meager. The asset of investment may be say 3% of the total balance sheet size, 5% of the balance sheet size. But the income may be very petty or not that big because the company plows back the profit. But the policy for the dividend has to be given. The amount of dividend may not be material. But the item or the transaction or the condition is in the balance sheet, which says that it is material because the investment from which the dividend will come is material. So in the given case where the revenue from EPC contract was there, even if one's project is small, EPC as a whole is a key business driver, and users need to understand how revenue is recognized in EPC. It is not in the general course that EPC accounting and other accountings are same. So EPC, maybe a small project is there, but the business is a driver over there. EPC as a whole is a key business driver, and user needs to understand how revenue is recognized. Similarly, as I was saying about dividend income, even if a small part of total income, it may be governed by specific recognition policy. And the asset from which this dividend will come, that asset may be material. So material accounting policy has to be given for such dividend income. And when we talk about financial instrument, any financial instrument, initial and subsequent measurement are critical for users to understand, regardless of whether the carrying amount are large or small. When we talk about material accounting policy, we have to also remember paragraph 7 of India's 1, which talks about materiality. Information is material if omitting, misstating, or obscuring it could reasonably be expected to influence the decision. So, if we talk in a layman language, anything which can influence the decision making of a stakeholder, that becomes material. The definition given in paragraph 7 reinforces that both size, quantitative, and nature, qualitative factors matter. And when we go for practical applications, like not disclosing APC revenue recognition policy or financial instrument measurement or employee benefit accounting policy is not compliant if the amounts are material or the nature of the transaction is such that the user needs the policy to interpret the figures meaningfully. When we summarize this discussion, related amount is material, always give material accounting policy. Related amount is immaterial, but the nature is material. Important type or category like EPC, like dividend income from investment, we have to give material accounting policy. If the amount is also immaterial and the nature is also immaterial, then we are not required to give the material accounting policy. I hope this would clarify the uh, context in which we were discussing.
Wonderful. Naturally, with all clarity, you have brought so many good things for the members. Now, my question to you only, Vivekji, while preparing financial statement of a private limited company, as per the Schedule 3, should we add notes of all heads prescribed in the balance sheet format, even though there are no balances under the specific heads? If no notes is needed, then can we change the schedule numbers or delete them? This is the question specifically asked for one of our member, Pramod Prasadji from Ernakulam.
Thank you, Hansraj. And it is a pertinent question. It keeps coming back many a time. Although it's a private company, we assume if it's an India's company. So if we have the guidance which is there from India's 1 and from Schedule 3 to the Companies Act, we may say, question was, are the notes required for all heads prescribed in the balance sheet, even if no balance exists? In my personal opinion, no. You do not need to provide notes to account for line items or heads where no amount or balance exists, unless there is some material or explanatory disclosure required. Index 1 allows materiality judgment. Immaterial information can be omitted if its omission does not affect the understanding of the financial statement. So whenever we have this discussion, there is one thing which comes out in my mind, that if there is specific disclosure required, if there is specific line item and there is an amount of that line item in our financial statement, we should disclose. If there is no figure in that line item for both the years, for comparative and current year, we may omit. And remember, whenever we are omitting any schedule or for that matter line item, there can be that the schedule numbers are required to be renumbered. And that comes to the second question in the given context. Can you delete or renumber schedule number if certain heads are unused? Yes. It cannot be that those are like patthar ka laki ki number आप change नहीं कर सकते. It is again illustrative schedule which is there. So Schedule 3 prescribes the format and general presentation, but allows flexibility for companies to tailor the numbering and presentation as per their specific circumstances, as long as the true and fair view is maintained. All material and required disclosures under Ind AS and Companies Act are included. The comparability and understandability of the statements are not compromised. So in other words, if certain schedules or heads are not applicable, you can skip presenting those schedules or even renumber the schedules for continuity, provided you maintain logical order and clarity. There is no requirement to show a nil schedule just because the format lists that head. And this also takes me back to some 15 years when we used to have that earlier Companies Act, and there was part one and part two to the schedule at that time. Remember, in one of our financials, we had given the word repairs and maintenance to building, repairs and maintenance to plant and machinery. And there was a compounding notice which we received because since childhood we have studied repairs and maintenance. And the notice said from ROC that Vivek, there is no word called repairs and maintenance in Companies Act that schedule that time. So you cannot merge two figures, repairs and maintenance. So you have to give repairs to building, repairs to plant and machinery, maintenance to building, maintenance to plant and machinery. And it was way back in 2010, I remember. And from that time, we understand if there is a word and if there's a figure, we have to maintain, or else we can skip. Don't do our merging ourselves, saying that repairs and maintenance is what we have read till school time, so we'll maintain that. Over to you.
Just to add what Vivek has very uh, lightly and interestingly put the point on repairs and maintenance, I just wanted to add that the general particulars for preparation of financial statement under Schedule 3, Division 2 and Division 1 in Division 3, in all the three cases, they are very clearly mentioning that relevant and reliable presentation of financial statement. So, assuming that if I'm just following the entire format and I have, for example, if the company is new, it has only the share capital and cash and bank balances, all other 4-5 pages, all are nil. It doesn't make any relevance. So accordingly, the judgment is whether this makes, as he rightly pointed out by Vivek, fair presentation, whether relevant and reliable information for the stakeholders has been presented. On that basis, you can delete, and in fact, you can even add, in case if you
Yes.
wanted to add a separate line item on the face of the balance sheet or on the face of the profit and loss account also, you can do it. For example, in one of our client case, what has happened was it is a hospital. And if you look at cost of material consumed is not there, changes in inventory is not because it's not having any trading activity, it is only the consumables, and accordingly that is also not there. And we have employee cost, we have depreciation, we have finance cost and other expenses. But if you look at the other expenses, the major cost is the payment made to the consultant doctors. So they wanted to show that this amount is the major component, and they wanted to show on the face of the profit and loss account. We shown that as on the face of the profit and loss account. It's finally the relevant and reliable information should be passed on to the user. That is the ultimate idea of the Schedule 3, and substance over form is more important.
Just to add to that, Ganeshan ji, in one of our clients way back 5-6 years, it was very cash generating client. So in the limited review financials also on LODR, the formats which is there, they always wanted to give that Vivek, I want to give cash profit separately at the bottom and give a proper note that company's cash profit has increased to this level. So additional information is always welcome. There is no issue in giving that additional information.
Wonderful, well discussed, well elaborated. Now my question to Ganeshan ji. The accounting policy on provisions state that provisions have not been discounted to their present value. The question is, are all provisions to be discounted, or there are certain exceptions to it?
I think this question is arising based on the review of an Ind AS financial statement and not based on an AS financial statement. If it is an AS financial statement, we'll simply say as per AS 29, the provisions are made without any discount being applied. It's an undiscounted basis only. It is provided as per AS 29. But Ind AS 37 makes it very, very clear when there is a provision which may actually paid in a subsequent year or years, the time value of the money has to be considered for discounting the provision as well. Because what is today, I'm making assuming that I'm estimating an outflow of resources in respect of one provision amounting to, say, for example, 10 million INR. After 3 years, I need not require 10 million INR today as the provision. because the time value of money goes diminishing over a period of time. And accordingly, I should find out what is the discounted value or net present value of that 10 crore required after 3 years. What is today's value? So the discounting for time value of money has to be considered under Ind AS 37, wherever you believe that the timing of outflow of resources will be not within 12 months, because within 12 months it is not material. Okay, so it should be after 12 months means you will normally have the discounting. Having said that, there is one exception to the rule of discounting is there, whether the discounting for time value of money is material to the financial statement. Because we understand that all accounting standards or Ind AS will be applicable based on the concept of materiality. If the discounting for time value of money, say for example, if the company's profit is say 10 crore and the discounted amount or the discount time value of money's adjustment required for the current year in the P&L account comes to say, for example, 1 lakh rupees, the user's decision on the financial statement is not going to be influenced whether you accounted this or not accounted this. Accordingly, taking clue for say 320, standards on auditing 320 on materiality, we will say this is not material, and accordingly, discounting for time value of money is not warranted. But there is a disclosure which is required to be given. If you are applying that exemption, you should say the impact of time value of money is not considered material, and accordingly, the provision has been presented on an undiscounted basis.
Yeah. Since we are on materiality, I thought I'll just extend it, Ganeshji, that in the last webinar, we had discussed about the audit modifications, and in depth it was discussed about materiality and pervasiveness to decide the nature of the modification. So from the participant, we have a question about how pervasiveness should be assessed when auditor is unable to determine amount.
Good point, sir. Because this is actually a dilemma which we normally have when we assess whether it is pervasive and material or it is only material. But the guidance given in SA 705, if you look at both on the standard as well as in the application guidance, they are talking about three aspects to decide on the pervasiveness. One is whether the particular adjustment which the auditor thinks about is going to have a material impact on one particular element of the financial statement. Second, they are saying lot of items together will having a a big impact or significant impact on the financial statement number. And third, they are talking about if a material disclosure required for understanding the financial statement is also not provided, that is also considered as part of the pervasiveness. So in case, in this example, I'm just taking it in two parts. The first part is it is not relating to any amount involved, but it is only relating to a disclosure. But in the auditor's judgment or assessment, then he believes that this is a material disclosure, still it is considered as pervasive. That is on the number, it's not at all involved, but disclosure is material or pervasive on understanding of the financial fundamental disclosure, then it is pervasiveness. Coming to the second part of the question, which I am splitting for the benefit of the audience, is that suppose it is relating to an account balance or it is relating to a transaction, but the auditor could not exactly quantify what is the impact. And because of that, he could not decide whether it is pervasive and material. Then we have to take the guidance when it is talking about adverse opinion or disclaimer of opinion. It very clearly mentions that one, based on the audit procedure carried out by the auditor concludes the identified misstatements plus the estimated possible misstatements, which is not identified, but based on his judgment, he believes that there could be a possible misstatement because certain items are not there. Put together has to be considered to decide on pervasiveness. Even for a disclaimer of opinion, where auditor will not find out any number, but his judgment will say, in his view, this amount is pervasive or and material, and on that basis he had to take a call. So in the given situation, for the second part of the question, which I split for the convenience of the audience, if the number could not be determined exactly by the auditor or even estimated by the auditor, but the auditor still believes this amount is going to have pervasive impact on any of a single line item or many line items on the balance sheet, then the auditor should conclude that it is pervasive. So number is not required to decide pervasiveness. Auditor's judgment, auditor's experience, auditor's conclusion on treating the identified misstatement and uh, probable misstatement, which is not identified, both has to be considered based on the auditor's judgment. On that basis, he has to conclude whether it is pervasive or not pervasive. Thank you, sir.
Yeah, very nicely explained about because this would definitely impact the audit report and the audit modification of the members or the auditor. Vivekji, on depreciation, the accounting policy that the company has disclosed, it mentions the estimated useful lives of items of the PP. However, the method of depreciation that has not been stated. So the questions now on this are what are the different types of the depreciation methods? That is the first question. Is it adequate to disclose only the useful life of assets without mentioning the depreciation method in the accounting policy?
Thank you, Vishalji. This question again, whenever we are not reporting the method of depreciation, it can impact or influence the decision making of any stakeholder. So before jumping to how it impacts, let's understand various. There are various types of depreciation method, but most commonly used maybe like SLM, straight line method, where depreciation is charged evenly over the useful life of the asset. Then we have written down value method or diminishing balance method, where depreciation is charged at a fixed percentage on the book value of the asset each year. Then you have unit of production method. Depreciation is based on the usage or output, like various mineral reserves, mines, they use it. And then there are various others like sum of years, digit, double, declining. But these are the most relevant or most commonly used depreciation methods. As per Index 16 and Schedule 2 to Companies Act, disclosure of the method of depreciation used is mandatory for each class of property, plant, and equipment. This ensures that the users of financial statement understands the basis of expense allocation over asset life. So is disclosing useful life alone adequate? No, it is not, because while disclosing useful life gives insight in the expected duration of benefit from asset, it does not communicate how cost of the asset is being allocated over its life. For instance, there may be two assets with the same useful life and having different depreciation expense each year, depending on whether SLM, that is straight line method, or WDV, that is written down value method, is used. Say asset is having a useful life of 5 years of value 100 crores. And if we follow SLM, it is 20 crores over 5 years. If we are following WDV, it will be more depreciation will be there at the start compared to that at the end if the useful life is same. So at the starting, it may be 25, 30 crores and it will diminish over the useful life of the asset. So omitting the method compromises the transparency and comparability of the financial statement and fails to comply with both Index 16 and Schedule 2 requirement. Back to you, sir. Thank you.
Mute पे रहे.
Yeah, there is a specific question from one of our participant in our last webinar. The question is, while calculating net worth, whether we should include other comprehensive income as well. This is the question to you, Vivekji.
Net worth is defined in Companies Act, and you also have to see how we are calculating net worth or what is the requirement. Because if I have seen in my practical application, net worth as is required to be given for IPO purpose net worth which is required to be given for various tenders which is there, net worth which is there as defined in Companies Act. And the definition of the net worth, whenever we are calculating the net worth, whether in AS or in DS, we should specifically define what we have taken and what we have not taken. Because with Ind AS and with fair value accounting, the things have changed drastically. Coming back to the question which has been asked, yes, other comprehensive income is included in net worth because it forms the part of the company's total equity. And under Ind AS, net worth typically refers to the total of share capital and reserve and surplus, including retained earning and other components of equity, which includes the accumulated balance of OCI. And the Companies Act defines net worth in Section 257, as I was saying. It says the aggregate value of the paid-up share capital and all reserves created out of profit and security premium account after deducting the aggregate value of the accumulated losses, deferred expense, and miscellaneous expense not written off as per audited balance sheet, but does not include reserves created out of devaluation of asset, write back of depreciation, and amalgamation. I was remembering when I was working for an IPO some 4 years back. People were saying, Vivek, the fair valuation of equity shares is also the valuation of the asset. Why you are using that for giving your net worth for your DHP and RHP? So to avoid this confusion, whatever we have taken for net worth, please define it because I disagree in that fair valuation and revaluation of asset is same. The fair valuation is the accounting requirement. The fair valuation, either through PL or OCI, is an accounting requirement. You cannot say that fair valuation is equivalent to revaluation of the asset because Companies Act definition pertains to age-old revaluation which was there always for PP and other assets. So notably, this definition does not explicitly carve out. It doesn't say that OCI is not required. And then in this, OCI sits directly within equity, like the foreign currency translation reserve, revaluation reserve, surplus, fair valuation reserves, etc. But outside the profit and loss account. Therefore, in my humble opinion, net worth includes OCI balances, except revaluation reserve, if any, for property, plant, and equipment in net worth calculation as they are part of equity. But as I said, you should exclude revaluation reserve because Companies Act specifically says that. And please make sure whichever certificate, wherever you are giving net worth, define what you are including and excluding in net worth. Because it's a perception. I have seen various tender documents where this definition is not there, where they say you give the net worth as per Companies Act, where they say you have to take this, and you have to exclude this. Otherwise, OCI generally should be part of net worth. Thank
So
you.
just to add also on the logic behind what Vivek ji was mentioning, if you see the OCA is actually classified into two categories. One is items which will not be recycled to the profit and loss account, reclassified to the profit and loss account, items which can be reclassified into the profit and loss account. Let us assume that items which will be reclassified to the profit and loss account automatically at one point in or other, it is going to the credit of the reserves and surplus, and it is available for the shareholders, part of the net worth. Second part is when we say it is not reclassified to the profit and loss account, the standard says that you have to make a movement in case if the particular item has been disposed of from your OCI, you have to move it directly as a balance sheet adjustment to the retained earnings. So in that case also, it is forming part of the wealth of the shareholders. So that is another logic why we should include OCI as part of net worth computation.
Thank you for adding it out. Now, Ganesanji, I'll be coming to you.
Yeah, please.
It was noted from the accounting policy that the royalty income is recognized by the company as per the terms of the agreement between the parties. The question is, what does Ind AS 115 specify regarding the accounting for sales-based or usage-based royalties?
Um, See, the problem which we are having always is that the mindset of there is no substantial difference between the usage of the words which was available under the existing accounting standard and what is available under the new accounting standard or Ind AS regime. So when we say the royalty income recognized by the company as per the terms of the agreement between the parties, the impact will be the same in both the scenarios, whether you use the word as per the agreement between the parties or based on sale based or usage based royalty, whatever you use, the impact on the financial statement is same. But the problem is when we were looking at AS 9, we are only going by revenue recognition based on the principles. Whereas under Ind AS 115, we recognize revenue based on contract with the customers, where the contract with the customer creates a performance obligation on the part of the entity. And once you have completed your performance, say at a point in time or over a period of time, depending upon that, revenue recognition comes in. In the case of a royalty, there could be two scenarios. One, usage-based royalty or sales-based royalty. That means if I start using an intangible asset or intellectual property right and using it, but that is only says that this is the period for which you can use it, then it comes as a usage-based royalty. Or maybe one example which Vivekji was also mentioning, based on what I will talk about, that I have a mining royalty where I use that and I exploit the reserves and then selling it. So usage-based royalty could also be fall into that particular category. The second scenario is when I'm making the sales to the ultimate customer, you are entitled to get a percentage on the sale value for using your intellectual property or using your technology or using your license, whatever may be. In both the scenarios, the accrual of income comes in accordance with Ind AS 115, only on completion of the performance obligation as envisaged in the contract with that particular customer. So accordingly, if I use the word simply that I'm recognizing the royalty income based on the terms of the agreement between the parties, it falls only under AS 9, whereas under Ind AS 115, the royalty income should be accounted for sales based or usage based that has been promised in exchange for the license or intellectual property right I have taken. This is also confirmed by paragraph 58 as well as the um, application guidance given in B63 of Ind AS 115. So accordingly, the usage of the words is important. You remember that in the previous session also we have talked about the accounting policy relating to revenue recognition has been considered by the company as when the risk and rewards of ownership in the goods has been transferred. Whereas under Ind AS 115, when the performance obligation and the control over the property has been moved is what we have seen. So the language is completely different because it talks about the performance obligation. So you should use the wordings in accordance with Ind AS 115, and you cannot simply say whatever I am following exists in the previous standard still holds good, because the impact on the P&L is same. You are misleading the party and you are not actually explaining what is the terms of the contract. Okay. So accordingly, when the performance obligation will get completed and when you can accrue the revenue should be very clearly known to the user of the financial statement. So in this present scenario, the usage of the language is incorrect. It may be suitable only for AS9, but under Ind AS scenario, they should use the wordings in accordance with paragraph 58 read with paragraph B63 of Ind AS 115 based on the performance obligation.
Thank you, Ganesh Ranjan. I think so that would clear a lot of doubts that members would have. I would just like to highlight to all the participants that our earlier webinar, we have web hosted the recording, the video of the last webinar is available. And to get the link of that, you can check our Twitter X account where we have put up a post sharing the link from where the recording of the earlier part of this webinar can be accessed from. Moving on to Vivek ji. This is on property, plant, equipment and capital work in progress. where many times I have also come across during my interaction with members that there are a lot of clarifications that members seek. So in one case, the accounting policy on PPE, it states that all project-related expenses incurred prior to the date of commercial operations are shown under capital work in progress, like civil works, construction, and erection material expense, pre-operative expenditure, net of revenue, incidental or attributable to the construction of project, borrowing cost, etc. So this is what was there in the accounting policy. Now the questions are, when does the recognition of costs in the carrying amount of PPE cease? And second, can you kindly give more example of costs that may be incurred before the commencement of commercial operations, but should not be included in the carrying amount of PPE? Because many times I've seen financials that, because it's in CWIP, everything you go and capitalize and like a P&L is nil. So maybe you can throw more light on this and give the necessary guidance, Vivekji.
Yeah, thank you, Vishalji. It's a very pertinent question, and with the startups, how they are working, I remember talking to one of the startup co-founder who happens to be my school friend. I said, boss, and he's a CEO himself. I said, boss, this expense has to go to PL. He said, Vivek, you want to say till I start my commercial operation, my PL will be negative. How can I show so much of loss? My investors will kill me. So that is how they start, like not only this, and last time we have discussed about research and development, the expenditure on the research and all the administrative expense and others, which people scheme, that anything which goes to PL goes directly to CWIP at the startup phase or whenever the commercial production has not started. So, and in this is particularly very clear, when there's the recognition of cost in carrying amount of PP ceases, the verdicts, if people understand, it's simple. Recognition of the cost in carrying amount of PPCs is when the item is in the location and condition necessary for it to be capable of operating in the manner intended by the management. This wording, in the manner intended by the management, should be the most focused word. Why? Suppose a machine is ready, the intended use can be done, but the company is not running in 100% capacity as there is no demand of the product. So it cannot be said that the demand of the product is not there, so we are running in the trial run or the test run, and we want to continue till we are able to generate the demand. The most important factor is about the demand creation, and people want to capitalize all the interest, all the expense till the demand has been created. And even if the asset has not yet been put to use or put into use or is operating below full capacity, if it is ready as intended by the management, it is assumed that commercial production has started and capitalization has to stop. Vivek, what are the costs which can be capitalized? Cost directly attributable to bringing the asset to the working condition can be capitalized only up to the point the asset is ready for its intended use. Intended use is a very important question point over here. Cost incurred after the point, even if incurred before the formal start of the commercial operation, should not be capitalized. In simple terms, the ready to use condition marks the cutoff point for capitalizing cost. Post that, all additional costs are generally charged to statement of profit and loss account. If we talk about examples of cost incurred before the commencement of commercial operation, which should not be capitalized, maybe like general administrative expense after commissioning, not directly attributable to preparing the asset for use, marketing and promotional expense, coming soon, launching this product, that product, creating the awareness in the market about the product. Those expenditure are not linked to the property, plant and equipment. It is not linked with the asset, and so it should not be capitalized. It is not directly attributable to the asset. Marketing and promotional expense like training cost for staff operating the new equipment, these are related to personal readiness, not the asset readiness. Operational loss incurred while building market demand again. Operating below capacity or losses are part of operation, not the asset. You cannot say that asset was not intended or ready to be used, therefore I'm capitalizing the loss as the market demand has to be created and I'm selling at loss. Idle cost due to delays, not part of cost to bring the asset to working condition, rather external factors. In this, a very important point is about the borrowing cost calculation as well, where the borrowing cost calculation has to be suspended if the management thinks that today there is a very economic system, economic condition is not good. There may be disruption in the operation of the company. So let's stop the construction for next 3 months, and interest should be capitalized because interest is being charged by the bank. But this delay of 3 months was within the power of the management or within the ambit of the management, and it could be avoided had the construction continued or the work continued. So interest cost for this 3 months should be suspended because the work was not done. And any testing, packaging, all those costs should not be added. Cost of relocating equipment after installation. It has happened in one of the paper mill I was doing audit, that there was a paper mill, the line 1, line 2, line 3. So management thought that line 1 should be removed from newsprint, and writing and printing paper mill has to be set up so many equipment could be used. So the expenditure incurred in the complete expenditure of the decapitalization and again capitalizing that was all expenditure for removing from point A to point B was capitalized. But this relocation equipment cost should not be capitalized or reinstallation should not be capitalized. So if we see, even if this cost happened before commercial operation, they cannot be capitalized because it is not directly attributable. So whenever we say about inventory valuation or for PPE, property plant and equipment, the focus should be clear. If it's a research, capitalization cannot be done, development capitalization can be done. If the borrowing cost is directly linked to the asset, capitalization can be done, but it should be suspended when there is delay due to the management's incapability or management decision of delaying the project. Any cost which is not directly linked to the asset should not be capitalized. And since the salary of the head office people, accountant, people say, Vivek, वो accounting तो CWIP का कर रहा हो, कुछ कर ही नहीं रहा है. We should avoid it. Depreciation, we should avoid it. And 2 days back, there was an important discussion going on, and client was like, Vivek, put to use as per income tax and commercial production from accounting perspective or AS, Ind AS is same. I said, no, sir. Put to use can be different from commercial production. Put to use on the date on which the asset has started doing trial run also, that is put to use. But commercial production is when it is ready as intended by the management. This difference, if we understand, I think capitalizing any expense becomes very easy. Thank you.
Yeah, just to add again, because we have to consider this into two aspects. One, the common error arises because people are forgetting the fact that the guidance note on expenditure during construction period has been already withdrawn with the introduction of AS 10. So they are still believing that the expenditure during the construction period anything can be accumulated. That I wanted to re-emphasize based on Vivek's point. There is no uh, the guidance note on expenditure during construction period has already been withdrawn, and accordingly no more accumulation of all the expenses even relating to a factory installation, new project installation can be of capitalized. So very elaborately Vivek has pointed out administrative, selling overheads, and what is not directly or indirectly connected with bringing the asset to the present location and condition for the intended use cannot be part of it. The other aspect is also one question which has been talked about is Vivek himself has made that point. One of the CFO has said in the initial period whether I have to show negative or losses in my P&L. That is also part of it. You cannot avoid it. For example, the preliminary and pre-operative expenditure, which we used to carry in the balance sheet as miscellaneous expenditure and amortize over a period of time, that is also removed with the introduction of our intangible assets, where this also removed it. And accordingly, in the initial periods, if there is no operation, naturally the company will be having a loss. That should also be made very clear by the auditors to the user of the financial statement. That is exactly Vivek has pointed out. Very nicely done, Vivek.
Thank you very much for nicely elaborating the points. Naturally, this issues remains whenever any capitalization or anything of that nature happens, and many times we find it's a difficult to identify and difficult to have a correct discussion. Thank you. Now, Ganesan ji, over to you. It was noted that impairment on investment has been deducted from the cost of investments, and the impairment loss has been recognized in the statement of profit and loss. The question which is there, what additional disclosures required in case of recognition of the impairment losses? Please provide few examples of situations that may lead to the reversal of the impairment losses.
Again, this question, we have to consider both under AS and Ind AS, because the way in which they have used the word cost of, it is deducted from the cost of investments, makes me to believe that they are under AS, not under Ind AS. But at the same time, all the companies which are coming under FRRB will be under Ind AS on a go-forward basis. I will discuss both. Even if you are considering as per AS 13 investments, long-term investments will be stated at cost less diminution in value other than temporary. This is a point which has been used in AS 13. Accordingly, deducting from the cost of investments and showing as a net value is perfect as far as AS 13 is concerned. Having said that, what are all the disclosures required? How you have assessed the impairment? What circumstances lead to the impairment? How you have valued the impairment or determined the impairment? And is it any possibility that you are expecting that it will get reversed? Should also be disclosed as part of the notes and accounts. In this case, it seems that they have just deducted and may not made any disclosure in the notes and accounts relating to the impairment of assets as per AS 28, which is incorrect if they are following under AS model. The second point which I wanted to consider is, in case if they are under Ind AS regime, all the investments will not be considered as a non-financial asset, and accordingly they will not fall under Ind AS 36. They will fall under Ind AS 109 as a financial asset. So the financial asset classification, as we aware that the investments may be, because it's a financial asset, can be amortized cost, or it can be under fair value through P&L or fair value through OCA. If the item of the financial asset or investment is not falling under amortized cost, but only treated as fair value through P&L or fair value through OCA, the impairment is automatically taken care by doing the fair valuation at the reporting period. And accordingly, the disclosure required relating to fair valuation level 1, level 2, level 3 as per Ind AS 113 fair value measurement, and other disclosures required as per 109 should be given. Why there is a deduction which we have made in respect of the investments. Suppose if the investment falls under the category of amortized cost, then the impairment loss will come into the picture, because we might have done the amortized cost accounting, and all of a sudden we have estimated that this is the discount which we have to apply, and this is not going to have any what you call value in use, or it doesn't have any fair value less cost to sell in that scenario, or it is lower than the carrying amount. In that case, necessarily additional impairment should be accounted for, even if the investment is under amortized cost. For example, investment in debenture will be coming under amortized cost. Investment in redeemable preference shares will be coming under the amortized cost model. In that case, additional amortization which is reduced not from the cost of investment, but from the carrying amount of the investment. That is exactly the difference between the words which has to be used. That is on that. The third part of the question is generic for both for AS 28 impairment of asset or Ind AS 36 impairment of asset. In both the cases, what are all the possible scenarios of reversal of impairment loss? When we are looking at the reversal of impairment loss, again, we will see whether it is relating to, in this case, it is an investment. So we will just take that investment. Automatically, if you are doing a fair valuation of the financial instrument or financial asset, and that goes beyond the carrying amount, market value or fair value, so automatically reversal happens. Reversal may also happen, fair value through OCI model. What happens is when there is a diminishing value of an investment or the fair value drops beyond the cost value, you cannot simply take the adjustment to OCI alone. If suppose I have already made a fair value adjustment and there is a credit which I have given to fair value through OCI, but now I have identified that the fair value has dropped dramatically. I have to see whether it is equivalent to the amount accumulated or less than the amount accumulated in the OCI in balance sheet. If it is less or equal to that, then the OCI will get reversed. Suppose if it is over and above that, then the difference should be straight away accounted in the profit and loss account. Okay. Similarly, when you are reversing also, what you have already debited to the P&L account, you have to reverse it as the reversal to OCI, and the balance only will be get adjusted in the case of fair value through OCI model. The instances where the reversal could happen for a non-financial asset as per Ind AS 36 or your AS 28 is, I have made an assessment that the value in use of the asset will be much, much lower. And because I'm going to abandon a particular model, there is no demand for this. The pattern of use of the asset has changed, all the internal and external factors put together. But now, all in a sudden, there is a demand which came for my product, which I never anticipated. For example, in COVID scenario, a lot of industries which were previously written off or impaired their assets came back to reverse it because all of a sudden the product demand has raised for some of the pharmaceutical companies, and they have actually reversed that impairment provision also. So when the assessment of value and use will be significantly differing from the original assessment, when you have accounted for the impairment, reversal will also happen. So you have to look at both internal aspects as well as the external factors which changes the value in use. Another possibility is also when the recoverable value by means of fair value less cost to sell goes beyond the initially accounted impairment loss, in that case also reversal comes in. Only difference between reversal of impairment loss for financial asset, reversal of impairment loss for non-financial asset is, if the non-financial asset is depreciable asset, when you are reversing the impairment provision already done, you must first consider what is the accumulated depreciation which you have to account for it as if no impairment has taken place from the date on which you have first recognized the impairment, and the catch up for the cumulative depreciation should be first adjusted. Only the balance can be reversed. This is the only difference between case where financial asset and non-financial asset. And there is a big difference between your AS 13 and Ind AS 109 because of the fair value concept comes into the picture. Thank you, sir.
Yeah. Thank you, Ganeshanji, for a very detailed deliberation, and you covered both the Ind AS and the AS aspects for this impairment. Moving on to Vivekji. So the next question is on Ind AS 19 employee benefits and the related disclosures, where in the financial statements, the description of the risk associated with the defined benefit plan was not disclosed. So the questions are, what disclosures are required under Ind AS 19 regarding the risks associated with defined benefit plans? And Just from an understanding perspective, why are such disclosures required and how can it help the users of the financial statements?
Thank you, Vishalji. There is three questions with this point, whereby the financial statements giving disclosure as per Index 19, the description of risks associated with defined benefit plan was missing. So when we see defined benefit plan, the disclosures which are required under Index 19 regarding the risk associated with defined benefit plan, uh, it says that a description of the risk to which the plan exposes the entity focused on any unusual, entity-specific or plan-specific risk and of any significant concentration of the risk. This means the financial statement should clearly explain the nature of the risk arising from the defined benefit obligation, any unique risk that is specific to the entity or the specific to the plan, and significant concentration of the risk, such as if a large portion of the plan's obligation or asset depend on specific economic assumption or demographic trend, like what are the various kinds of the risk or some examples? They can be investment risk, they can be interest risk, they can be salary risk. So why is such disclosure required? These disclosures are required to improve the transparency of the financial statement, help user understand the impact of the defined benefit plan on the entity's financial position, and highlight the vulnerabilities due to specific or concentration risk, comply with the faithful representation and material principle under Index 1, which we have discussed earlier. And how could it help the users to assess the financial stability and sustainability of the entity, evaluate the likelihood of future cash outflows, if any, understand how sensitive the obligations are to the change in economic or demographic assumption, and to make more informed investment or lending decision. So as I said, most of the companies are now moving to this defined benefit plan, and now it is giving to outside entity. So they are trying to do away with the risk and also opting for various other benefit plans which are there. And some companies keep on creating the trust and run the defined benefit plan in the trust. So the risks which are associated may differ on the basis of the structure with which the company runs for the plan, and the risk, as I already said, maybe like investment risk, salary risk, interest risk, and all these risks are required to be disclosed for better understanding of the financial statement, to have a well-informed decision for any stakeholder to be taken in regard to the company. Thank you.
Yeah, thank you very much for a wonderful clarity. Now I'll be again going to Ganesan ji. Sir, while giving unmodified opinion, the auditor has reported that subject to note given above, the Ind AS financial statement give the information required by the Act in the manner so required and give a true and fair view. The question is it appropriate for the auditor to provide an unmodified opinion with the statement subject to the note given above? That is the question with you.
So I'm just taking this in accordance with SA 700, SA 705. So if I'm talking about SA 700, where there is a clear or unmodified opinion which I have given on the financial statement, so it should not be conditional on any matters. I should very clearly form an opinion that there is no further adjustment required. There is no conditional thing based on which the true and fair value is arising. The moment I use the word subject to, that makes that the opinion I have expressed is conditional upon certain matters. That conditional upon certain matters could be leading to qualification, leading to disclaimer, or maybe leading to adverse opinion as well. So subject to, since they have used the word subject to, I believe that it is not pervasive and there is no scope limitation. So there is no uncertainty of the amount to be recognized. Auditor could form an opinion of what could be the possible impact of the misstatement. So it is also not pervasive, so it's only material. So auditor is saying that it's subjective. The moment he uses a subject to, he has to qualify his audit opinion in accordance with SA 705. And moreover, because he uses the word subject to and it's a modification, the first paragraph, which is opinion, should be changed to qualified opinion. The basis for opinion should be changed to basis for qualified opinion. So if the auditor wants to issue an unmodified opinion with the word subject to, completely incorrect.
Right. So, Ganeshanji, continuing with the auditor's opinion. This was a question asked by a member, and I'll ask it to you, sir. Earlier, auditor and the company had wrongly disclosed the securities premium as share pending for allotment in the financial statements. Now, how does the incoming auditor handle this particular situation?
Okay. So again, this is part of one standards on auditing, opening balances. When I am taking over an audit from the previous auditor, in the other matters paragraph as per SA 706, it requires me to mention that the comparative period financial statements are audited by another firm of auditors who have expressed whether a modified opinion or unmodified opinion, what is the date of their audit report also should be form part of the uh, other matters paragraph in my audit report when I am taking over from the another auditor. When it comes to the case, that doesn't mean that whatever the previous auditor has done erroneously also, he has not qualified his audit report or there is a wrong uh, classification as in the present case comes in. The new auditor cannot just keep quiet. The new auditor will normally correct the error in the current period. And the moment he corrects or reclassifies that particular item in the balance sheet or the P&L, in this case, it's a share premium. So it is on the balance sheet side, the moment he classifies from share application money to share premium, naturally, the previous year number should also be reclassified to give a proper comparison. So when I am reclassifying a number which was already audited by another auditor, it falls under rectification of error as per Ind AS 8. The moment there is a rectification of error as per Ind AS 8, the standard says it should be applied on a retrospective basis. That is the date on which the error has originally occurred. If the error has occurred in the comparative period, then I can restate the number in the comparative period as well as the current period, I can finish it up. If it has happened earlier to the comparative period, then also I have to reclassify that numbers. And of course, since it is not in a P&L account, it's only a balance sheet item, no adjustment will be coming to the retained earnings. But having said that, Ind AS 8 also requires a third balance sheet should be presented as part of the notes on accounts whenever you are correcting an error. So accordingly, what was the original balance sheet? What is the adjustment proposed? And then what is the revised number? The revised number should be matched with the current year classification of the current year number as well as the comparative period number. And the explanation of what is the error and what warranted for the correction of this particular error, including reclassification, should be explained by the auditor. The auditor cannot say, I have relied on the audit opinion given by the previous auditor. If there are errors, it should be considered as a prior period adjustment as well. I have seen enough number of cases wherever a new audit has been taken over. Sometimes it's a mentality of the auditors also to find errors of the previous auditor's work rather than doing a proper audit of the current year. And they wanted to make at least 2 prior period adjustment in the financial statement. But I always used to say Ind AS 8 also applicable based on material adjustment. If it is not material, don't try to show that you are smarter than the previous auditor. That is not, he is also your fellow colleague. Second is, if it is immaterial, Ind AS 8 says no reclassification is required, no disclosure is also required. It makes it clear. But in the present case, because it's share application money and share premium, amount will be really material. So it will be reclassified in the comparative period as well. And then Ind AS 8 should also be applied and the disclosure should be made in accordance with Ind AS 8. Thank you, sir.
Yep. Thank you. I think so that was answered in quite detail, covering the aspects of materiality as well as the standards on audit. Vivek ji, this is now again on a very, I would say, common question, I would say, on the ECL, that in one of the cases, it was noted from the notes to accounts that the company has a material amount of trade receivables classified under current assets, whose realization is based on arbitration outcome. Now, the question against this is that, can you explain the concept of the expected credit loss approach as prescribed under Ind AS 109, and whether in this case ECL should have been made?
ECL, again, very close to many people and very away from many corporates. The concept of ECL under Ind AS 109 is about incurred loss has been done away with and expected credit loss has been brought in. Ind AS 109 introduces the expected credit loss model for impairment of financial asset, replacing the old incurred loss model. When I say financial asset, it is for all the financial asset, not for picking and choosing that I would do ECL for this, I would not do ECL for that. And when we say about ECL, it applies to financial asset measured at amortized cost, fair value to OCI, lease receivable, contract asset, loan commitments, and financial guarantee contracts as well. What is ECL? ECL represents the weighted average of credit losses with the probability of default as the weight. We can say it is a forward-looking and considers possible future credit losses, not just the past event or current condition. Entities must estimate expected rather than incurred losses. And how to measure it? For trade receivable, Ind AS 109 permits very simplified approach, meaning lifetime ECL is recognized immediately regardless of the credit risk change. And for other assets, there is a three-stage approach, applies shifting from 12-month ECL to lifetime ECL depending on credit deterioration. In the given case, where the trade based on arbitration outcome was there, the fact pattern provided was that there is a material amount of trade receivable and the realization of this receivable depends on arbitration outcome. That is, there is uncertainty over whether the company will ultimately collect the amount. So why ECL applies here? Because trade receivable are financial asset under Ind AS 109. Even if the arbitration is pending, the company must assess the probability of recovering the receivable and recognize an allowance for expected credit loss based on historical loss experience, current condition, and reasonable and supportable forecast of future events. Now, non-provisioning effect ignores the uncertainty and overstates the asset carrying amount and profitability. Therefore, yes, an ECL allowance should have been made considering the arbitration introduces uncertainty. There's a clear expectation requirement under Ind AS 109, and ignoring ECL understates the impairment and misrepresents the company's financial health. Not only that, we should also evaluate the outcome of the case with the help of the legal experts which are dealing the case, and also explore, apart from providing ECL, whether any contingency is required to be given, a contingent liability has to be created or not. And reviewing the contingent liability apart from ECL is also an important aspect for this discussion. Thank you.
Thank you, Vivek ji. Wonderful, well explained. Now I'll be going a question with you. Fixed deposits were kept under lien against a borrowing by a corporate. FD was for a period of 12 months. However, borrowing is for 5 years. Whether FD to be classified under the current or the non-current financial assets? That is the question.
Thank you, Chukji. I think it's a very tricky question and very relevant in today's ecosystem, how corporate runs. when we say FD is for 12 months, it should be other bank balance. But even though the FD is for 12 months, if it is under lien against a long-term borrowing or long-term non-current borrowing and is not freely available, it should be classified as non-current financial asset because its use is restricted for more than 12 months. And it comes from the Index 1 classification between current and non-current, which is based on expected realization or use. An asset is current if it is expected to be realized or consumed in entity's normal operating cycle. In the given circumstances, the FD is not expected to be realized in the normal operating cycle or assuming the 12th month has been assumed to be normal operating cycle. So because this FD is not expected to be realized within 12 months, which is the normal operating cycle, looking at the question which is there, the asset is non-current and because it does not meet the condition of the realization within 12 months. So as said, not only for FD, because the FD is although for 12 months but marked as lien, and many times these long-term borrowings are there where the bank asks for FD for the margin money as lien for the LCs, and sometimes the bank also there's a compulsion from bank to invest in various mutual fund till the loans are there. All this should not only be seen by the plain vanilla, uh, but more deeper should be there. And what is the business sense in investing or putting that money in FD should be looked into. Uh, Similar to this, there's one more example given in India's one, where there are some loans which are rolled over every year. And if a loan is rolled over every year, it can be taken for as a non-current loan, although it can be for within 12 months. But the circumstances is that as per the government regulation, the loan cannot be given for more than 12 months if it's in the foreign currency. So every year it is rolled over, and the companies has an intention to keep it for more than 12 months. So similarly, in this case, the FD is for 12 months, but it is not expected to be realized or consumed in the normal operating cycle, which is 12 months in the given case as per the question. So it should be shown as non-current.
Yeah, thank you. Thank you, Vivekji. Now I'll be moving to Ganesanji. Ganesanji, many a time we have seen many companies are presenting the figures without providing the effect of the rounding off in their financial statements. What all are the criteria for rounding off the figures as per the Schedule 3 of the Companies Act? Is rounding off of figures mandatorily under the prescribed guidelines? That you have to explain.
The rounding off is again misunderstood concept because when we had original Schedule 3 before the introduction of Division 1, Division 2 and Division 3, the general particulars for preparation of the financial statement as per the Schedule 3 use the word before the table for rounding off may be rounded off. That was the words which has been used. The moment we started using Ind AS and the Division 2 financial statement has been published, it has been very clearly mentioned that shall be rounded off. The change of the word from maybe to shall be clearly communicates that under Ind AS regime, you have to mandatorily round off the figures presented in the financial statement. There are two things which has been given for the threshold limit, what you can use, what you cannot use. For example, if the total revenue is less than 100 crore, you can use hundreds, thousands, lakhs, millions, etc. You can use. In case if it is more than the total income is more than 100 crore, hundreds and thousands are not possible. One more additional item is crores can also be used. The rounding off also uses the word in thousands, lakhs, millions, and decimals thereof. This is what the usage which has been used. That means if somebody wants to give full number, it is not possible. That is full rupee number, it is not possible. When I'm using the rounding off as lakhs, I can give, say for example, 126 lakhs I can give, or if I wanted to give 126.54 lakhs, that is also possible to give. Decimal thereof can also be used, but it is mandatory to use the rounding off under Ind AS regime. Only difference now I am seeing is that for the financial statements, as per the guidance note issued for financial statement for non-corporate entities, still the guidance uses the word may be rounded off. But for an Ind AS company, which is coming under the purview of FRRB, mandatorily it should be rounded off based on whether the total income is less than 100 crore or more than 100 crore. You can use full values alone, or you can use decimals of that lakhs, decimals of millions, etc. also can be used. That's also
Just
from
to add to Ganeshan ji, what we have also seen, people round off in lakhs and crores, but in the running notes, they give full figures many a time.
that
Or the
is another
auditors
point.
also give the full figures many a time. So that is also non-compliance and which is really ignored by people. And with the latest formats given for non-corporate entities also, the only question they ask is, Vivek, I have to make a rounded off financials for ROC, then complete figure for income tax, for tax audit. How do I maintain? Well, it's quite simple. You have the same financial, you have a round off sheet, and you have the full figure sheets. And whenever we have seen various the annual reports of the listed company also, the running notes, the auditor's report have something in crores are there in the balance sheet, and auditor report talks about lakhs, and vice versa, or full figure. So that is also a common error which we have noted many a time.
Correct, because Vivek, the same unit of measurement should be used throughout the financial statement. Is what is the exact paragraph which is there, and accordingly you cannot use for balance sheet and P&L and cash flow statement lakhs, and then for the notes and accounts. So same unit of measurement. And in fact, one interesting point also we have seen. It uses the word there should not be any special prominence should be given for certain items. So in our office, maybe we wanted to be very conservative view. The when we are doing the printout of the financial statement, we are saying that you have to say what is the fixed percentage of the printout should be. 70 for the balance sheet means 70% for the P&L, 70% for the cash flow statement, 70% for the statement of changes in equity, and 70% for the notes on accounts also. Because we don't want somebody is interpreting that you are giving a prominence for your balance sheet, but you are not giving the prominence for your P&L, which is making losses. It's a very interesting point which I missed out. Thank you.
Yeah, sure. So, Vivekji, this is on goodwill. An entity, it has a substantial amount of goodwill on the balance sheet. However, adequate disclosure with respect to the source of goodwill and its accounting policy has not been provided in the financial statements. So, can an entity recognize internally generated goodwill as an asset under Ind AS 38? If not, which goodwill should be or can be recognized in the financial statements, and what disclosures are required for that goodwill and its impairment?
A very pertinent question. Thanks to Vishalji for this question. It's a very pertinent question. Like a entity cannot and it cannot recognize internally generated goodwill as an asset. And this is explicitly prohibited under Index 38, intangible asset, and which states that internally generated goodwill should not be recognized as an asset. And whenever an entity recognizes goodwill, how will it recognize? Only goodwill which is acquired in a business combination may be recognized. This is addressed under Index 103 business combination, where such goodwill is recognized as the excess of the consideration transferred over the net identifiable asset, which we say PC minus NATO, that is purchase consideration over net asset taken over. And what is the required disclosure? If goodwill is recognized, it is acquired, not internally generated, the entity must disclose the source of the goodwill. That is the business combination in it allows form. A reconciliation of the carrying amount of the goodwill at the beginning and at the end of the reporting period as per Index 103. Impairment testing is compulsory whenever goodwill is recognized, impairment testing has to be done as per Ind AS 36. Paragraph 10 says over there that which impairment of the asset which requires that goodwill must be tested for impairment annually, regardless of any indication for impairment or not. So non-compliance which is observed, that there is substantial goodwill on the balance sheet without adequate disclosure of its source and accounting policy, and the entity has failed to disclose the impairment testing. Whenever we go for a new client comes in, we have seen in present 2 years back only that there is good amount of goodwill. And when we ask for the reconciliation of those goodwill, which are the business combination from which it has come, or from which it has arose, the same is missing. And obviously, impairment testing is very much required every year, compulsory, whether there is any indication for impairment or not. The testing has to be done. And if an auditor is there, the documentation has to be done by the auditor for impairment testing of the goodwill. And whenever we talk about goodwill with business combination, people are now very, what to say, has come up with new ways of accounting for customer contracts in purchase price allocation with trademarks, rights, so that they can impair it and take the claim on the income tax, with the income tax getting amended time and again. Now goodwill is not being accounted over there, and in purchase price allocation, justifying that goodwill, it becomes very difficult. So goodwill can only be accounted when it is purchased. If goodwill is accounted, from which business combination it has arisen. Secondly, impairment testing has been done or not. Impairment testing has not been done, it will be non-compliance. So impairment testing has to be done. And impairment testing was done, and there was no impairment loss that has to be specifically written and documented by the auditor.
Yeah, thank you very much, Vivek ji. Now, Ganesan ji, the financial statements indicate that the company holds financial assets, including investments, loans, and trade receivables, as well as financial liabilities, such as borrowings and trade payables. However, the methods used to measure the financial assets and liabilities have not been disclosed. Why is it necessary to provide the disclosure for measurement basis of financial instruments? What are the different measurement bases? Now you have to explain in detail.
All these are financial assets, so clearly falls under Ind AS 109. The moment it falls under Ind AS 109, the disclosure requirements are coming from Ind AS 107. So the first part of the question is, when we were talking about what are all the different categories in which the financial asset will be presented. We were talking in another previous question on a passing comment that the financial asset has to be classified either as amortized cost or fair value through P&L or fair value through OCA. The classification is dependent on a rule-based or a flowchart type of conditions which has been attached. It is again, in another question, Vivek has mentioned that the cash flow characteristics of the asset and the business model of the entity. If the business model of the entity and the cash flow characteristics, business model of the entity is to collect solely payment of principal and interest, and the cash flow characteristics is also solely payment of principal and interest, it will go to amortized cost model. If the cash flow characteristics of the instrument is SPPA, that is solely payment of principal and interest, but the entity's business model is to hold it till maturity as well as to sell, then it falls under fair value through OCI model. Suppose the model of the entity is not clear whether it will be in the residual category, fair value through P&L. Similarly, if the SPPA test is not passed or it is failed, automatically it will be reclassified as fair value through P&L. So this is the normal classification which is available for a financial asset. One more additional classification which has been given, we have also discussed a little bit on this. If it is investment in equity instruments of another entity, there is an irrevocable option which can be exercised by the entity to consider that as fair value through OCA. And in Another question Vivek ji has mentioned that you cannot even take the profit on sale of that particular investment to the P&L account. It should be routed only through the OCA because it is never reclassified to the profit and loss account. So these are all the classification. One is amortized cost, another is fair value through P&L, another is fair value through OCA, another classification is option exercise which is irrevocable in respect of equity instrument as fair value through OCA. The question is why it is mandatory to have this classification is because when the financial instrument has been acquired, asset or liability has been acquired, they will be recognized at their fair value on the date of acquisition, not on the original cost, but on the fair value on the date of acquisition. If there is any difference between the cost of acquisition and the fair value, then the day one profit or day one losses will be taken to the P&L account. That is what Ind AS 109 talks about it. And when this is for the initial measurement, subsequent measurement depends on the classification. If I say it's amortized cost, I will work out the amortized cost at every reporting period and adjust the carrying amount and the amortized cost I have worked out as part of the adjustment to the P&L. If it is fair value through P&L, the increase or decrease at the fair value at the reporting period will be taken to the debit or credit of the P&L account as the case may be. If it is fair value through OCA, the increase or decrease in the fair value will be adjusted as increase or decrease in the other comprehensive income. That is the reason why these classifications are becoming mandatory under Ind AS 109. Thank you, sir.
Yeah. Thank you, Ganeshan ji. Vivek ji, it was noted from the note on contract balances. So, Ind AS 115 related question that the company had contract assets in the form of unbilled revenue, that is the work in process. And there was a significant change in the balance of contract assets as compared to the previous year. So, the question is that in context of 115, what exactly do we mean by a contract asset? And second, what are the disclosure requirements relating to contract balances under Ind AS 115?
When we talk about contract asset, it is very much relevant. And when we say about unbilled revenue, the most of the service industry, the unbilled revenue becomes very important because in the manufacturing industry, the WIP is there physically tangible, can be seen, but the unbilled revenue in the service industry is very much relevant and the large corporates actually follow it. But some of the small enterprises, I have seen some of the SME listed DRHPs, it is not there. So let's define contract asset. Contract asset is under Ind AS 115 arises when an entity has performed by transferring goods or service to a customer with the right to payment is conditional or something other than the passage of time. That is, the entity's right to payment depends on future performance or events. Specifically, it represents the entity's right to consideration in exchange for goods or service transferred to the customer that is not yet billed. Once the entity's right to payment becomes unconditional, except for the passage of time, the contract asset is reclassified as a receivable. Example, if a company completes part of the construction project and is entitled to consideration only after certification of the work by the customer, the unbilled portion is a contract asset under certification. If we talk about something relevant to small size practitioners, suppose a company CA firm started doing physical verification of the asset in the month of February, and they was required to do tagging of the asset and make the FAR, that is fixed asset register, as per the requirement of Schedule 3 and in the AS. The 2 months have passed, but the contract says only when you get it completed and our auditor gives a clean report, then it will be given to you, the money will be transferred to you, the payment will be due to you. So till March, whatever work has been done, you have done the service has been transferred, but it is not yet, you are not entitled to receive the money as of now. And when we talk about disclosure requirement related to contract balance under Ind AS 115, paragraph 116 and 18 of 118 of the Ind AS 115 requires detailed disclosure around contract balance, including qualitative and quantitative information. Vivek, what are those disclosures? Opening and closing balance of the contract asset and contract liability. What is contract liability? Like advance from customers. Receivable, if presented separately. Explanation of significant changes in contract asset and contract liability during the reporting period. That is changes due to business combination, if any. Cumulative catch-up adjustment from the change in transaction price or performance obligation. When the transaction price or the contract price is dependent on something else, suppose it is dependent on the price of gold, it is dependent on the index, then it will be cumulative catch-up, or it is dependent on the cost plus basis. So what has been the cost which has been incurred? It is again cumulative catch-up. Impairment losses recognized on the contract asset or this is and change due to transfer of goods or service or fulfillment of performance obligation. Thereafter, we have to also disclose the revenue recognized in the reporting period from the amount included in the contract liability balance at the beginning of the period, because we would have received some customer advances, and from those customer advances, there would be some sales we would have been recognizing during the year, revenue from operation, and then performance obligations satisfied in prior periods. So practical experience used, if any, such as not adjusting for the effects of a significant financing component if the gap between the transfer and payment is less than 1 year. Because if it's more than 1 year, then the significant component, the financing component, has to be shown separately. And quantitative reconciliation or rule forward where needed, showing how balance changed over the period. So when we summarize all this discussion, contract asset liability receivable has to be disclosed, revenue recognized from opening contract liability, significant change in the contract balance, practical expedience used for accounting of the contract asset and contract liability has to be given. Again, this area of the contract asset, contract liability reconciliation is an important aspect, requirement of paragraph 116 and 118 of India's 115, and proper reconciliation for those has to be seen from service orders which are there, from the open work contracts which has been there in the service industry. It becomes very important, and with the timesheet or MIS, if any, which is there, and all the large corporates giving services, they have the concept of timesheet and billable hours and budgeted hours and actual hours performed. So from this detail, this has to be derived. Thank you.
Thank you, Vivek ji. Now moving to the next question, Ganesan ji, over to you. Many companies we have seen have stated under the notes to the accounts that previous year's figures have been reclassified or regrouped. Question is, what disclosures are required to be made when a reclassification of the figures is carried out under the Ind AS system?
Okay. This is also another common misunderstanding on reclassification or regrouping, which is we observe on a regular basis whenever we review the financial statement. I just wanted to split that into two parts. Whether the reclassification is relating to current and non-current classification of an asset or liability, or it is a reclassification of a normal asset and liability from within the particular category, we are reclassifying that item. Within current, we are reclassifying that item. Similarly, P&L, whether any reclassification or regrouping is happening. With respect to current to non-current, if we are doing a reclassification, we cannot do a reclassification according to Ind AS 1 because previous year it may be non-current based on the circumstances which was existing as on that previous date's reporting period. Whereas in the current year, because the expectation to realize the particular asset or the liability is due to be settled, naturally that becomes a current asset or current liability as the case may be. In that scenario, current year it will be shown as current asset or current liability, but the previous year figure should not be reclassified or regrouped. It is very clearly or explicitly mentioned in Ind AS 1. Only one exception which they are saying is, suppose if in the previous year the classification is wrong, that is there is an error in the classification in the previous year, then you can reclassify the previous year comparatives also between current and non-current, but at the same time evaluate whether Ind AS 8 shall be applied for rectification of prior period errors, you have to do it. This is part one of my answer. If it is a current to non-current, you are changing an asset, comparative should not be restated. Coming to the other reclassification or regrouping in the P&L or balance sheet, whether it is permitted or not permitted, people are having a feeling that regrouping is not permitted at all. Reclassification is not permitted at all. And accordingly, they are having a feeling that such a note is an incorrect note. That's what some people are having a thought. I just wanted to take the prescription given in Ind AS 1, paragraph 41. If an entity changes the presentation or classification of items in its financial statement, it shall reclassify comparative amounts unless reclassification is impracticable. This is what Ind AS 41 says. That means current year when you are reclassifying, comparative should also be reclassified unless if it is impracticable. The moment you have reclassified, there are disclosures required. What is the disclosure required? The nature of reclassification, the amount of each item of or the class of item that is reclassified, and why you are reclassifying. These three are you have to give. Okay, I have also started with the conditional statement unless it is impracticable. If it is impracticable, guidance comes from paragraph 42 of Ind AS 1, where it says the reason for not classifying the amounts because of impracticability and what is exactly the nature of adjustment that would have been made if the amounts has been reclassified. You have to say, in case reclassification is possible, what could be the possible adjustment which should be there? Not exact amount, but what could be the possible impact that should also be disclosed. And what is the reason for impracticability should also be disclosed. So accordingly, as per paragraph 41 and 42, reclassification is still permitted and the disclosures required is in accordance with Ind AS 1, paragraph 41 and paragraph 42. Okay. Thank you.
Ganeshanji, just continuing, because this was a question, which was asked by the audience also. And that you mentioned with respect to Ind AS, what would be the position with respect to IGAP?
In IGAP also, there is no difference, sir. Because the position is remaining the same in IGAP also. Because Ind AS is more rigor and IGAP is comparatively the disclosure and other requirements are more detailed. So it is more or less the same. There is no difference. The actual interpretation comes because of wrong understanding of your standards and auditing relating to opening balance validation. And there they are saying if there are some errors or something like that, they have given how to handle that errors. Some people are misinterpreting that if there is an error in the opening balance, it's a correction of error. So reclassification will not be possible. And you cannot say to conform to the current year classification you can give. Both under GAAP, IGAP and Ind AS, the position is same.
Just to add to what Ganeshanji said, just to add to that, a very pertinent point in that, and this came into light when we were doing the first time adaptation in 2016-17 also, and has been discussed in detail in various FAQs which were there that time. Information available at that time, because information available 2 years back, information available 1 year back, and information available today. Many people have this also point of contention. Vivek, something was non-current last year, but this year also have to show non-current. No, it is 12 months from the balance sheet date which has to be checked. This concept, there is some gap. If I have shown an FD non-current last year, whether this year we have to show? No, we have to check. And over there, people make mistake because FD maturing within 3 months, people want to show cash and cash equivalent. No, it is original maturity less than 3 months, which will be cash and cash equivalent, because that is the definition given in Index 3. So people have this conception that 3 months from the balance sheet date, whether it will be cash and cash equivalent. No, it is 3 months from the original maturity. And other bank balances, 12 months from the balance sheet date. So this basic misconception is still there in people, in spite of being 7-8 years old now. There is this misconception.
Yeah, so actually Ind AS is almost a decade old now. 2014, if I look, because recently we celebrated the AS Day and where we had a panel discussion on this very specific point on the Ind AS completing 10 years and our takeaways from that. The next question is to Vivek ji on Ind AS 40, though not used that frequently in India, but yes, whenever used, it has its own interpretations. So, and I would say that is maybe because it's not being used so frequently in India. Uh, Vivek ji, the accounting policy for investment property, it states that the investment property, it includes furniture and fixtures, plant and equipment, and office equipment. Now the questions are, is it correct to include furniture, fixture, plant equipment, office equipment as part of investment property according to Ind AS 40? If not, what assets are included within the scope of Ind AS 40 as investment property?
Vishalji, and this is again a pertinent question. There is some practical difficulty in this. We'll come to the practical difficulty in the later part. Let's understand what is the requirement of the standard. In this 40 on investment property, it is correct to include furniture, fixture or not? No, it is not correct. Why? Because paragraph 5 of the Ind AS 40 says investment property is limited to property held to earn rentals or for capital appreciation or both. The standard does not include movable assets such as furniture and fixture, plant and equipment, or the office equipment within the definition or scope of investment property. What assets are included within the scope of investment property? Under Ind AS 40, investment property includes land, building, part of a building, combination of land and building. This must be held for rentals for capital appreciation or both, and not for use in production or supply of goods or service, or for administrative purpose, or for sale in the ordinary course of business. So, if we say real estate asset and not operational or movable asset qualify as investment property. Now, I am assuming this disclosure comes from when? Suppose a person has taken a property of 5 crores and invested 1 crore in the interiors, which includes air conditioning, which is deemed to be plant and machinery many a time when we are doing the accounting for factories. It includes furniture, fixture, the interior work which has been done. And this furniture and fixture and plant and machinery, although when we are doing audit for the factories or we are doing for the office, we show it separately. But when we are incurring this expenditure in the property, plant and equipment, in the investment property, as the definition says, part of a building. So it should be added to the flat or building and not shown separately as furniture and fixture and plant and machinery. That is my understanding. And that depreciation or the investment property will be 4 crore say property value plus 1 crore investment in the interior expenditure which is there. In this 4 crore plus 1 crore 5 crore will determine what will be the rental income which I will earn. So saying that investment property includes furniture and fixture, plant and machinery is incorrect. How it should be shown, because practically many people buy this property for 4 crore and invest in the interiors so that they can give it as a PG or maybe for rentals to corporates. That 1 crore should be part of the building and added to the building or flat and not shown separately as plant and machinery or furniture and fixture. That is my assumption. Thank you.
Thank you very much. Thank you, Vivek ji. Now I'll be moving to the Ganesan ji. Ganesan ji, from the note on fair value measurement, it was noted that all financial assets and liability of the company were grouped under level 2 hierarchy. Explain the level 1, level 2 and level 3 inputs of fair value hierarchy and what additional information to be disclosed for the level 2 hierarchy. This is the question.
Okay. Actually, Ind AS 113 fair value measurement gives the guidance on whether the fair value should be arrived at based on level 1 hierarchy or level 2 or level 3 inputs. Level 1 is equivalent, is nothing but quoted market price when it is available. We have to use the quoted market price straight away without giving any adjustment for discounts or premium. That is level 1. So it is readily available as a quoted market price. Level 2 is I don't have quoted market price exactly for the item which I am having, but I have an equivalent item available in the market. I make some adjustment where I will maximize market based inputs or public inputs I will use and do a valuation adjustment for deriving at my fair value as per level 2. This is level 2 is I make an adjustment for the market price and arrive at what is my price. Level 3 is when quoted market price is not available or identical asset is not available, then I will be depending entity specific inputs and not based on market specific inputs. So it is completely a valuation technique when I'm using it. That is the reason why level 1 assumes the first priority, level 2 is the medium priority, and level 3 is the last priority where we have clearly demonstrated it is not quoted investment, equivalent quoted price is not available, etc. In the given example, the note which is given is all financial assets and liabilities of the company were grouped under level 2 hierarchy. If the financial asset or financial liabilities are quoted in the market and value is available, fair value is available in the market, then the classification of those financial assets and liabilities for which quoted market price is available, grouping under level 2 hierarchy is incorrect. Level 1 should be applied. I'm not sure whether level 3 is applicable for certain items of the financial assets and liabilities of the company. So accordingly, grouping everything under level 2 may not be appropriate, but we have to look at the complete details of financial assets and liabilities and to conclude indirectly whether the level 2 hierarchy which has been applied by the entity is correct or not. Having said that, if level 2, assuming that we agree with the presentation given by the company that all the financial assets and liabilities are started with the market value and then adjustment has been done based on market available inputs and level 2 hierarchy is justified, let us assume. But the note is only saying that all the financial assets and liabilities of the company were grouped under level 2 hierarchy, not enough. If it is level 2, there are additional requirement or additional disclosure which has to be made in accordance with Ind AS 113. And the information about the valuation technique, the inputs used for the fair value measurement are to be disclosed for level 2 hierarchy. And it seems that the same is not found in the disclosure which is there. And accordingly, even if you assume that all the assets and liabilities are under level 2, the disclosure made as per Ind AS 113 as well as Ind AS 107 relating to financial asset seems to be not fully complied with, and to that extent there is a error in the presentation of the financial statement. So that is my view, sir.
With
Very
due
well
permission,
explained.
if it,
Yeah,
sorry,
yeah,
sorry, Vishal sir. With due permission, if I can add just one line.
of
There was this
course.
question with one of the finance controller who called me when they were acquiring a company that Vivek, there is a share in investment in quoted shares, and the aggregate market value of the quoted share is different, and the fair value through PL for that quoted share is different. How it can be? Then, and in the balance sheet, it is showing level 2. Why they have to take level 2 for quoted shares? The people forget that level 1 is for the quoted price of the actively traded shares. If the shares are not actively traded, they go to level 2 and do the other information has to be used to click to the level 2 price. So this is again a misconception of maybe non-compliance which many industry I have seen, where they say level 1 is if you have a share price, it is level 1, although there is no trading for last 5 years.
True. So, Vivekji, coming to you now about inventories in days 2, and this is one area where we believe as a board also that this is one of the simplest standards, but unfortunately we are still able to find observations and which have been published in our various publications also. So, In one of the cases, it was noted from the accounting policy on inventories that raw material has been valued at weighted average method. So, like I mentioned, that we have seen during our reviews that there are different non-compliances in accounting policies regarding inventories. Can you highlight the correct manner of giving inventory policy or accounting policy regarding inventories?
Thank you, Vishalji. Again, as I actually said, this is important, and you know where the most of the corporates they go behind and they say there's no clarity on it about weighted average. Going to the other disclosure, let's discuss weighted average. Whether it has to be yearly weighted average, whether it has to be quarterly weighted average, whether it has to be moving weighted average, nothing has been defined. And because most of the corporate follow this weighted average method without defining whether they are taking moving weighted average yearly, quarterly, in most of the commodity company, we have seen company having major raw material as commodity, like you may say edible oil or steel industry. If there's a falling price, we'll see that the NRV will be more compared to the cost of the asset, cost of the inventory. So in one of the instances when I was just reviewing, and for everything there was a NRV was lower. My simple question is whether the company is doing cash losses. Answer was no. Then how can your NRV will be less than the cost in most of the cases? When it was identified that the company was following the yearly weighted average, and it should not be a correct practice to follow with a yearly weighted average for industry where the raw material price or the finished goods price are fluctuating like anything. So that was on the weighted average, and the correct accounting policy requirement is that the company has to give the valuation basis and the cost formula. Correct manner of disclosing inventory accounting policy is the valuation basis, like as per India's 2, inventory should be valued at lower of cost and NRV. Mind you, over here it is NRV and not fair value. Major deviations or major non-compliance is also about the fair value, where the company states that the inventories are valued at lower of cost or fair value. So it is lower of cost and NRV, not fair value. This must be explicitly stated, and the cost formula. The cost of inventory should be assigned by using specific identification for items not ordinarily interchangeable, or a cost formula like FIFO or weighted average. For interchangeable items like raw materials, the cost formula used, example weighted average cost, should be mentioned separately after the valuation basis. So the requirement is that the cost formula should be given and the valuation basis should be given. And when I say cost formula and valuation basis, valuation is NRV or lower of cost or NRV, whatever is there, the value of the inventories should be valued at lower of cost or NRV, and the cost formula either weighted average or FIFO. And in weighted average, if a company is more prudent, they should mention whether it is moving weighted average, monthly weighted average, quarterly weighted average, or yearly weighted average. Depending on what company follows, it gives a better presentation. But the requirement of the standard is valuation basis and cost formula. And what is taken in the cost, that has to be given. Cost incurred to bringing the inventory to the point of sale. Everything which has been cost which has been incurred to bringing the inventory to the point of sale. So that is the requirement in the given case. Only it was mentioned that the accounting policy on inventory, that the raw material has been valued at weighted average cost. It should be weighted average cost and cost or NRV, whichever is lower, both should be mentioned. And not only for raw material, for finished goods, WIP, everything it has to be mentioned. So I think that was the non-compliance over here, where mainly stating raw materials are valued at weighted average method without mentioning lower of cost or NRV omits a crucial part of India's compliance. And valuation and cost formula both should be mentioned. Thank you.
Thank you very much, Vivek ji. Now I'll be moving to Ganesan ji. Ganesan ji, in the reporting under Karo, while reporting in pursuance to paragraph 3, then subparagraph 7 and B, then the auditor has reported that there are no material dues which have not been deposited on account of the dispute. Naturally, this is the phrase on no material dues. Is it the appropriate considering it may be exclude minor disputed dues from being reported? Ganesan ji? I think,
उनका
Network issue,
network.
some network issue.
yeah, some network issue. Vivek ji, can you on this point, you can elaborate what is your view or?
Yeah, so I'll ask the next question to Vivek ji, and
Ji.
by that time Ganeshan ji can join, and Chuk sir, you can again
Yeah,
repeat. So
yeah, yeah.
Vivek ji, this is on VRS Ind AS 19 again. That it was noted from the accounting policy on VRS that expense on the VRS is charged to the statement of profit and loss as incurred. Does this accounting policy align with Ind AS 19? If not, what should be the correct accounting policy?
Thank you, Vishalji. In the given case, the accounting policy that states expense on VRS is charged to statement of profit or loss as incurred. It does not align with the requirement of Ind AS 19 employee benefit. Specifically, when we talk about the later paragraphs like paragraph 165, while the current policy is non-compliant because Ind AS 19 requires that termination benefit, such as those from VRS, be recognized at the earlier of when the entity can no longer withdraw the offer of those benefits. If suppose the offer has been given and it becomes a liability as the entity is not able to withdraw the offer, and when the entity recognizes cost for restructuring under Ind AS 37 that involves termination benefit. So the trigger-based recognition, not a general as incurred method, simply expensing VRS cost when incurred may result in delay recognition, which goes against the principle of reflecting obligation as soon as they are committed. So the correct accounting policy in those cases should be expense on VRS are recognized as a liability and charged to statement of profit and loss at the earlier of the date when the company can no longer withdraw the offer of the termination benefit, or when the company recognizing restructuring cost that involves the payment of the termination benefit in accordance with the requirement of Ind AS 19 and Ind AS 37. So just by saying that it is recognized as and when incurred is incorrect, it should be earlier of both. When it becomes a liability, that is the company entity can no longer withdraw the offer of those benefits, or when the entity recognizes the cost for restructuring under Ind AS 37 that involves termination benefit if any restructuring has been done. Thank you.
Sorry, my internet connectivity was disturbed, but I could hear the question which you have raised on Caro on the whether the undisputed statutory dues which has been paid, material undisputed amounts has been paid is what is the phrase used. Caro should be understood that it is not an accounting, it is not an audit opinion, it is a statement of fact, and accordingly material and non-material is not coming into the picture. So as per the guidance note issued on Caro, even immaterial items should be covered. If we are giving only material items as been deposited and there are no delay, then it will be communicating as if we are not tested the other items at all. So the phrase is not correct. It's a quick answer which I wanted to give.
No, thank you very much. The next question to you only. Sir, Ganesan ji, as per the segment reporting disclosures, it has been divided into primary segment and secondary segment, and the disclosure accounting standard 17 segment reporting IGAP has been given. It has not provided the necessary disclosure as required by the Ind AS 108. The question comes in, what are the key characteristics for determining operating segments in accordance with the Ind AS 108? Next, in case a company falls within the single reportable segment, what are the disclosure requirements that it needs to comply with?
For want of time, I make specific answers for this rather than giving a lot of examples. First is AS 17 segment reporting and Ind AS 108 operating segments are operating in two different models. AS 17 is talking about whether risk and rewards of operating in a particular segment is similar or dissimilar. If it is dissimilar, another segment comes in as per AS 17. Accordingly, for a company which falls under FRRB, if they are using AS 17, that itself is incorrect. First point, that is an error. Second is 108 talks about whether the segment is identified from the point of view of the management or from the point of view of the chief operation decision maker who reviews the financial performance of each of the segments independently for the purpose of their results and for allocation of further funds. So the chief operation decision maker or MIS becomes the important point for Ind AS 108, based on which reportable segments will be identified. And after that, all other criteria which we have seen in AS 17, like aggregation criteria, identifying the specific reportable segment based on three criteria of turnover, and then results, and then assets, etc. And 75% of the segments has to be minimum covered. So other segments also will be included. All other things are remaining the same. But what you have to do is your segment should be what the CODM reviews. If CODM reviews three segments and you conclude that you are operating in one single segment, it is incorrect according to that, unless there is an aggregation criteria which is possible to apply. This is 108. Coming to the conclusion that we have only one operating segment under Ind AS 108, whether that is enough, that the company operates in one single operating segment, so on, so and so, as per Ind AS 108. Whether that stops the disclosure? No, because even if the entity is operating in a single segment, there is a requirement to disclose the other factors as well. For example, a standard says that there are disclosure requirement where the auditor should look at disclosing, say, concentration of customer. See, for example, there are three paragraphs which we are talking about the additional disclosure: 32, 33, 34. Even if the entity operates only in single segment, 32 requires information about the product and services covered by the segment. 33 is what are all the geographical areas in which the operating segment falls. And third, that is 34, paragraph 34 is who are all the major customers, that is who contributes more than 10% of the turnover should be covered as part of this. So the paragraph 32 or 33 and 34 will apply, and disclosure has to be made even if the entity concludes they have only one reportable operating segment.
Yeah,
Sir,
thank you.
with your permission, can I take the questions which has come from the audience on a quick basis, sir?
Yeah, so we have just one question from our original question bank to Vivek
Yeah,
ji.
sir. Yes, sir.
And
Yes,
then
sir.
we will have the rapid fire because yes,
Okay.
there are questions and we would want to definitely have your inputs for the benefit of the participants. So Vivek ji,
Okay.
it's regarding Ind AS 107 financial instruments, where it was noted that the company had loans, advances, trade receivables, investment in quoted shares. However, the disclosure of risks has not been made. So what are the different type of risk disclosures required, and why are such disclosures required? How would it help the users of financial statements?
Thank you, Vishalji. The Index 107 gives very specific risk disclosure, and it is very specific what is there, what is not there. So, what are the different types of risk disclosure required? Index 107 requires disclosure of the nature and extent of risk arising from the financial instrument to which the entity is exposed at the end of the reporting period. This typically includes, but are not limited to, like credit risk, the risk of financial loss due to counterparty's failure to meet its contractual obligation. Liquidity risk, the risk that an entity may not be able to meet its short-term financial obligation. Market risk, including currency risk, interest rate risk, other price risks like commodity price risk and equity price risk. Disclosure must include both qualitative and quantitative information to allow users to evaluate the risk and how they are managed. And why are such disclosure required? These disclosures are required to bring transparency. They give users insight with potential vulnerabilities in the entity's financial structure. Risk evaluation, they help users assess the risk associated with the financial instrument, which is crucial for investment, credit, or regulatory decisions. And performance understanding the risk management strategies allows users to better evaluate the entity's performance and decision-making procedures. As many companies have this hedging done, like a company which is dealing in gold ornaments, having retail stores of golds, or maybe a company which is in the crude oil market or in edible oil refinery. They have lots of this commodity risk and foreign risk. So how the change in that foreign currency will impact the profit and loss positively or negatively on both sides. Say a 1% deviation in the dollar change, how it will impact the financials of the company. 1% change in the commodity price, how it will impact the company. So this performance understanding is very much important for any stakeholders or investors. And then predictive value, knowing the entity's exposure and how it's managed helps user predict future cash flows, profitability, and solvency. So these disclosures contribute to forming an overall picture of how risks are inherent in the financial statements and how entities' resilience and exposure to external economic factors are there. And reading this risk along with the director disclosure and director information, you can get the understanding of how exposed the entity is to various other risks like commodity, forex, etc. So that's why these risks are very important for understanding the financial instrument. Thank you.
Yeah, thank you, Vivekji. Now, Ganeshanji, you can respond to the audience questions because we also have got few. So whatever, if you leave back anything, then we'll definitely shoot off to Vivekji.
Sure, sir. Sure, sir. The questions, other than what we have already answered, the first question is, Company A has investments in group company equity shares, which were taken at fair value through OCA at the Ind AS transition, that is on preparing the opening Ind AS financial statement. Can this be reclassified to fair value through P&L at a later state? If yes, under which situation it is allowed? So if the equity shares have been fair valued through OCA based on the business model of the entity and the cash flow characteristics in the opening retained earnings, then it is possible for reclassifying that. If the business model changes, then the fair value through P&L reclassification is possible. But if the fair value through OCA for the equity shares have been applied based on the mandatory irrevocable option available as per the Ind AS 101 exemptions available, then you cannot reclassify that particular item. So fair value through OCA, mandatory option exercised, no reclassification. If it is based on business model and cash flow characteristics, you can reclassify at any point in time, is the first question. The second question is whether equity share in one company can be valued through fair value through P&L and in another company can be valued through FVOCA. Again, the concept of business model of the entity is important. If the business model of the entity for investment in certain equity shares are going to be retaining that, as well as you are going to sell it at any point in time, or if you are going to use that particular model, still it's a fair value through OCA could be possible. In another case, so accordingly, one can be fair value through P&L and another can be in another category also. It is possible to do that. As per Ind AS, next question is, as per Ind AS 19, what is asset ceiling? See, normally what will happen is when we make a provision for gratuity or any other items based on actuarial valuation, we look into what is the fair value of the obligation estimated by actuarial valuation and what is the fair value of assets already existing. So the difference between these two, if it is a liability, then we debit the expenditure and create a liability to make a provision towards the gratuity and match it with the actuarial valuation. Suppose if it is ulta, that is the fair value of the plan asset is higher than the fair value of the obligation at any reporting period, can I recognize this as a prepaid item as an asset? Is the question comes under Ind AS 19. For which Ind AS 19 says you can recognize that asset only to that extent of what we call it as a asset ceiling. Is asset ceiling is nothing but What is the present value of economic benefits available in the form of refunds from the plan assets? And what could be the possible reductions you can make from the future contribution? If the total plan assets which you are having, you can reduce the contribution you can make to the next in the next period, that is called asset ceiling. For example, if it comes as a there is a policy premium also you have to pay, and there is an asset available, you cannot say the policy premium also I will adjust. That premium has to be paid to keep the plan asset alive. So that will be charged to P&L. Only the balance will be carried forward. That is exactly the asset ceiling. Next is, do we need to book DTA on provision for doubtful debts uh, in respect of debtors balances being from a subsidiary which was admitted into CIRP? You remember that Ind AS 22, sorry, Ind AS 12 and AS 22 both are talking about whether the difference is probable of reversing in the subsequent period or periods. In this particular case, CIRP is happening and the balance is outstanding from the subsidiary. So there is no possibility of recovery, and accordingly, whatever provision I have made will be totally written off. And to that extent, there is no possibility of recognizing any DTA in case if a particular item of temporary difference will never get reversed. In this case, I have made it very clearly it is under CIRP and the amount will be written off. So no DTA should be recognized. Disclaimer of opinion is the next question, whether financial statements with an audit report with disclaimer of opinion are any use for the stakeholders. Unfortunately, it will not be useful for the stakeholders, but at the same time, the stakeholders should understand that the entity has limited the scope of the auditors. They have not provided the appropriate audit evidence. That matter at least goes to the stakeholders. Stakeholders would understand that something may be wrong with the company. That communication will be possibly is there. The next question is on SA 505. What is the most commonly used practice or system to get balance confirmation from major debtors and creditors? External confirmation as per SA 505, the auditor has to monitor the entire sending, receiving, reconciling the entire external confirmation. There are exceptions available to get it from email and additional conditions which the auditor has to do it. But the most popular practice and best practice is directly sending it through an evidence of having sent it, kept it in record, and collecting it directly. Otherwise, you monitor the entire external confirmation process, control the entire confirmation process is the best method. The next question comes is, what are all major deviations in the audit report, specifically in case of small companies? Actually, there are no difference in the deviation in the audit report. Entire audit report are same. Maybe for smaller companies, CARO may not be applicable, and reporting on internal financial controls may not be applicable. Other than that, the format given in SA 700 will apply to small companies as well. And of course, reporting on SA 701, key audit matters will not apply. The last question which is there in my list is that, do we show exposure at default in the balance sheet, that is principal outstanding less the excess money received, or should we directly show only the principal outstanding at the balance sheet date? I think it is on the ECL model which has been considered. So when we are talking about the ECL model, exposure at default is important. So net balance is what has to be considered, is according to my view. These are all the questions which are pending to be answered from my side. If there are any further questions which the moderators are shooting to me, I will be happy to take.
Yeah, thank you. Thank you, Ganesanji. Now, Vivekji, there are the certain questions from our participants, the viewer, for you also. I'll be coming to you. The development expenses can be amortized over what period? That is the question with you.
Development expense that meets the capitalization criteria under Index 38 should be capitalized as an intangible asset and then amortized over their useful life. That is the period over which the asset is expected to generate economic benefit. So what is the useful life? That has to be ascertained by the management, and thereafter, over the useful life, the same should be amortized.
Yeah. The next question is PPE has been sold on credit in current financial year and the amount against the same has been received in the next financial year. What would be the impact of the above transaction on the statement of the cash flow in the current and the next financial year?
So let's break this down carefully. Step one, understand the transaction. That is, PP was sold on credit this year, that is current financial year. It will appear in the statement of profit or loss as a disposal and removal of asset carrying value, but no cash was received in the current year. The cash was received in the next financial year. So actual cash inflow will happen in the next financial year. So what is the cash flow classification? Cash flow from the sale of PP are classified under investing activity, and cash flows are reported only when actual cash is received, not when the sale is recorded. So in the current financial year, sale entry will happen, no cash flow effect yet, just a non-cash investing activity. And in next year, cash flow statement, except possibly in the non-cash disclosure note, if material has to be given. And next year, when the actual cash flow happens, that has to be shown.
The another question is, does IND AS 115 permit to use input method and output method for few projects in case of an EPC company? All the projects qualify as over period of time.
Yes, Ind AS 115 permits an EPC company to use the input method for some projects and output method for others, provided the method chosen for each contract faithfully depicts the transfer of control and progress towards satisfying the performance obligation. So, like we have discussed in detail that under Ind AS 115 for performance obligation satisfaction over time, company needs to measure progress towards complete satisfaction. The standard allows two broad categories, that is the input and output method, and the company can use the input method for some projects and output method for other. The proper accounting and records should be kept for same, and the company should faithfully depict the transfer of control and progress towards satisfying the performance obligation.
Yeah, another question is there a difference in the GST return and the books of accounts? What type of opinion should we give?
This difference will not give apparently any effect on the opinion. You do not automatically qualify the audit opinion solely because of the difference between GST returns and books of accounts. Instead, we have to assess the materiality of the difference and whether they indicate material misstatement or non-compliance affecting the financial statement as a whole. Only if this difference are material and unresolved should they lead to a modified opinion. In some cases, it may be that in the GST sale would have happened, but actual delivery would not have happened. Therefore, the return would be not accounted as a sale in this year. So all these reconciliations are there in Form 9 and 9C of GST, and if those are material, and apparently it's not just the timing difference, but there is some gap and material gap, then only it should affect your opinion. Otherwise, this happens in general course of business, and they should not affect your opinion of audit.
Yeah. There is another case, 100% Indian subsidiary private limited company incorporated in India. That is 100% equity shares are held by a foreign company which is incorporated outside India. The turnover of the Indian company is less than 1 crore and paid up capital is 1 lakh. Whether the Indian company is a small company for application of the accounting standards.
Just with the plain reading, no, the Indian private limited company is not considered as a small company under Section 285 of the Companies Act because it is a subsidiary of a foreign company, even if its turnover and paid up capital fall within the threshold. Therefore, it is not eligible for exemption available for small companies under Companies Act, and for accounting standard applicability, it cannot claim the small company relaxation.
Okay. There is a similar question. Private limited company exemption limit for Caro has crossed, but it is a small company. Whether Caro is still applicable, what is your view?
Yes, even if the private limited company qualifies as a small company under Companies Act 2013, CARO 2020 will apply if it crosses the prescribed exemption limit under CARO rules. The small company status under Companies Act does not provide exemption from CARO.
Okay. Your view related with the important areas of non-compliances which you find in the financial statements.
There's a long list of practical list of important areas where non-compliance is commonly seen, and we have to go through the volume 1, volume 2, volume 3 of the FRB publication, along with the non-compliance for non-corporate entities or for the small companies. For the years, there is separate compliance. But when we see about the basic incomplete or incorrect application of Schedule 3, Division 1 or 2, non-compliance with Ind AS or AS disclosure, which is there, non-compliance with cargo reporting, everything comes into that. So last year's 4-hour recording, this year's 6 hours recording. Apart from that, the FRB compilation, we have to go through everything for that list of non-compliances.
Good, good. You see, like this addressing the limited review report, to whom it has to be addressed?
The LR report, limited review report, is addressed to the board of directors of the company. This is because the limited review under the SEBI LODR regulation or as per standard practice is conducted on the quarterly or interim financial results prepared and approved by the board. And the report is formally submitted to the board. Thereafter, the board submits wherever required. Even if it's a consolidation and you are an auditor of the group company, then also will address to the board, and the board will then thereafter give to the group auditor or the parent auditor.
Okay. The next question is SEBI requires last quarter figure to be balancing figure. Is it not infringement of the interim reporting standard? What will prevail, legal form or the Ind AS?
See, when there is a conflict between SEBI regulation and Ind AS accounting standard, there's a conflict. SEBI requirements prevail because legal and regulatory mandates override accounting standards in India. This means even though Ind AS 34 interim financial reporting requires each interim period to be prepared discretely, SEBI allows that the last quarter figures to be derived as a balancing figure, that is full year audited minus 9 months reviewed, and companies must comply with the SEBI directive for the listing entity regarding reporting. Apart from this, the yearly audit report is separately also published and submitted with ROC. And there's a very detailed disclosure under the notes on accounts that the quarterly figure has been derived from the audited figure of this full year deducted, and then unaudited figures have been deducted from same to derive the quarterly figures.
Right. So we have some questions which have come in today. So quickly, we'll just try to run through them as maximum as possible. So Ganeshanji, on the Caro, Para 3 requires reporting on the loans and advances to holding subsidiary associates and other parties. The other parties is not defined and hence includes employee loans. Reporting on employee loans dilutes attention on the core subject of the RPT. So what are your views on that?
So actually, if you look at the previous Caro and what is the new Caro, the previous Caro is not using the word other parties. So the intention of law is only to look at the related parties where the company has given loans or advances in the nature of loans, and they wanted to highlight that particular point. But having said that, since the language has been changed, the guidance issued by the institute also says that all the loans and advances you have to look at and you have to consider reporting on that. So if it is employee related advances also, that should also part of that particular disclosure as per the guidance issued by the institute, because of the language has been changed in Caro 2020.
Vivekji, please clarify on disclosure of deposits with original maturity of more than 12 months, expiring within 12 months and expiring more than 12 months.
For basic understanding, when the original maturity is less than 3 months, then it will be cash and cash equivalent, apart from those which has been given as lien. Apart from that, any loan which is having maturity less than 12 months from the balance sheet date will go in other bank balance, and those having maturity more than 12 months from the balance sheet date will go to non-current. So original maturity is only seen for those loans which are having less than 3 months and which are not given as lien. That is taken as a cash and cash equivalent. Apart from that, any loan having maturity more than 3 months, less than 12 months from balance sheet date will go to other bank balance, and more than 12 months from the balance sheet date will go to less than 12 months in other bank balance, and more than 12 months to other non-current assets.
Fine. So Ganeshanji, where It has been asked that it's a government undertaking, GOI undertaking, and one of our loan defaulter company X has been liquidated and NCLT has issued order for settlement. But the board does not have the power to write off till the approval is received from the Ministry of Finance. What should be the accounting treatment of this loan asset?
Very simple, sir. I think the loan asset will fall under financial asset. So in your ECL model, this will automatically go as a credit impaired. So 100% provision will come in. Write-off will happen when the ministry approves it. But the provision has to be made in accordance with Ind AS 109.
Right. Vivekji, two questions to you quickly. Duty drawback is to be presented under revenue from operation or other income in the statement of profit and loss. And second is on, do we need to do actuarial valuation on provisions made for cash award, which is a long-term incentive policy of the entity, which will be paid after completion of 3 years?
Yeah, any payment to the employee after on the termination or after more than 1 year has to be valued by the actual. And for duty drawback, it will be other income. It will not be your other operating income. It will not be revenue income.
Fine. So,
Sorry. Just to add that there are diversified practice in respect of duty drawback because they believe that because of the operation it arises, so it is not other income, it is forming part of other operating revenue. There are divided presentation and both are acceptable according to my view.
right. So, Ganeshanji, again on the opening balance, there is a question that the auditor found that the stock auditor's report and the opening stock is not tallying with the physical statements maintained, and there was a mistake regarding the value of the opening stock. So, how does the auditor rectify this mistake?
So if it is an Ind AS company and the amount is material, they will go back and adjust in the previous year figures with an adjustment in the opening retained earnings and make the disclosure as per Ind AS 8, including the third balance sheet. And if the amount is not material, Ind AS 8 itself says that the correction can be done on a prospective basis in the current year, but you can make a disclosure of what is the corrections you have made. So that will be the better way of handling the situation.
Right. So next question, Vivekji, on CWIP, I would have, so there are two, so I'll shoot off both to you with reference to the CWIP. Would project insurance premium, which is something like an erection or risk policy, paid or reimbursed to the contractor, be eligible for capitalization? And second is whether any income earned from the product generated in the testing stage, should it be deducted from the cost of the asset?
For the generated, the net profit or loss has to be ascertained. And there has been a EAC opinion, I think, last year on this, where it has been given that the test run profit and loss has to be deducted from CWIP and shown as turnover separately, and then specific disclosure has to be given. And for the insurance for the project, as it is directly linked to the project, without that, the construction contractor will not work. So it can be capitalized under CWIP.
Right. So now a final set of questions, one to each of the panelists. Ganeshanji, corporate guarantee given on behalf of other corporates to the bank, whether required to be presented as a contingent liability?
Naturally, yes, because you are taking a risk. In case if they fail, you are supposed to make good the losses. Naturally, it should be disclosed as a contingent liability. And I was thinking the moment you started asking about guarantee, whether they are talking about fair valuation of guarantee as per
Valuation of the guarantee.
there is
This
a
was a
divided
simpler
opinion
one.
on that. Yeah, there is a divided opinion on that. Okay.
Great. Yeah. So last but not the least, Vivekji, interest paid on shortfall of advance tax is to be shown as finance cost as per guidance note on Schedule 3. Now, the member has said there can be two situations resulting for this shortfall. First, absence of cash flows for payment, and second, due to variation in the estimate of advance tax liability, though the company has sufficient cash flows. Now, in the second situation, is it fair to include interest on such shortfall in payment of advance tax as finance cost?
it will always be finance cost. Government thinks you are a god. You have to presume what will be your income and you have to pay tax. And now with this year starting, all the partnership firm has to deduct this also on the salary given to the partner, which will be known at the year end.
In fact, the question on 234C interest has to be accounted as a current year expenditure or only as the next year expenditure. There are some people who are saying, because I have not filed the return within time, that arises subsequent to the balance sheet date, so it is a next year expenditure. But fortunately, Institute guidance set the controversy into rest, and all these things are part of the borrowing cost.
Not only that, Ganeshan ji, people have to understand the publication of the institute is so great. 2 days back for my one of the client, I had a simple question whether leave will be short term or long term leave liability. They said it will be long term, but the guidance no specifically says if the employee has any right to take on the leave next year, it will be current. It will not be non-current. Although the actual valuation comes at non-current, but people say actual valuation has done the work. I am relying on the work of third party. I'll show you that's not current. But you have to go beyond the actual valuation and discuss why it is current, why it is not current, and what is the actual scenario. And it is very specifically given in the guidance note. But someone has to read that guidance note.
Excellent. So we are dot 5:30, and I understand the way Ganeshan ji, Vivek ji, both of you answered the last half an hour rapid fire. You must have been appearing in a lot of quiz during your school days, and that shows the technical expertise and the knowledge that you carry. That whatever were the questions, you were able to respond to them immediately. So with that, over to the respected Vice Chairman, Chuk sir. Over to you, sir.
Thank
A simple
you.
question to the FRB and Chairman, Vice Chairman. How is the feeling with the 50% increment from last year 4 hour session to this year 6 hour session?
I tell you on both the occasions, let me be very honest. We have almost 3,000 participants on today as well as the last webinar. And we are getting a lot of positive feedback in the comment box also, which are there. So that in fact encourages us and would motivate the team to continue this journey of not just physical programs, but also in the virtual mode, especially with the accounting standards. This was more focused on the Ind AS. Maybe in the month of August beginning, we would definitely line up something on the accounting standards also.
Yeah, that was I was going to request because masses work on accounting standard. Although on this Saturday I am going for FRB session on accounting standard to Rourkela, but the masses require FRB session on accounting standard online as well.
Right. Yes, Chuk sir, over to you, sir.
Thank you. Thank you very much. I can understand the clarity with which our both the speakers, Ganesan ji and Vivek ji, has brought us more stronger in our understanding, and the way the rapid fire round without that is really our chairman has well spelt ki how strong the knowledge base sounds to be. I'm really grateful and thankful to both the speaker, Ganesan ji and Vivek ji, for always being there with this board, more particularly with all the other boards and the committees of the ICI also. Really grateful and thankful to both of you, Vivek bhai and Ganesan ji. And the way really our chairman is leading from the front as far as this board is concerned, though he has the past many years naturally he's been bringing out so many changes in wherever he is. Particularly, I'm enjoying the as a vice chairman the methodology he really take care of whatsoever the issues, whatsoever the challenges, and how the members to be brought in to a next level as far as the quality is concerned. The errors normally is been made with those kind of big thought. Our chairman is always been proactive in bringing out this board to the newer level. Thanks Vishal bhai for really being so energetic and so powerful and so proactive for this board and for the cause of the profession. Thanks to the secretariat also, I have really seen Ankita and her entire team working for the cause of this profession. And thanks to the last but not the least, each and every participants with such a large number, that shows how our membership are really been thought of about the quality delivery and best of the knowledge to be taken care of. Ultimately, the knowledge is the power for each one of us. And thanks to each and every participants too. Thank you all. Thank you very much.
Thanks, Chuk sir, for always being there,
Excellent opportunity,
supporting
sir.
the
Thank you.
activities. Thank you. Thanks to everybody. Thank you.
Thank you,
Have a
everyone.
great
Thanks to
evening.
the audience for joining. Thank you.